In this presentation, we will take a look at the allowance method and the direct write-off method. These two methods involved in the valuation of accounts receivable and the writing off of bad debt expense. This will be a long presentation. If you would like to jump to relevant points within it, take a look at the description below, which will have links to those points as well as a description of what will be included at those relevant points. If you'd rather see this in a playlist format, we will also have a link to a playlist type format as well as links to other accounting videos. In this presentation, we will take a look at receivables. The major two types of receivables and the ones we will be concentrating on here are accounts receivable and notes receivable. There are other types of receivables we may see on the financial statements or trial balance or chart of accounts, including receivables such as rent receivable and interest receivable. Anything that has a receivable in it basically means that someone owes us something in the future. We're going to start off talking about accounts receivable. That's going to be the most common, most familiar, most used type of receivable. And that means someone, some person, some company, some customer typically owes us money for a transaction happening in the past, typically some type of sales transaction. So if we record the sales transaction, that would typically be the way accounts receivable would start within the financial statements, meaning if we made a sale, we would credit the revenue account. We'll call it sales. If we sell inventory, it would be called sales. If we sold something else, it might be called fees earned, or just revenue, or just income. Increasing income with a credit, and then the debit not going to cash, but going to accounts receivable. This is a transaction that should be fairly familiar. This is going to be a transaction that happens fairly often. We made a sale on account. And of course, if we made that sale on account and it was inventory, then under a perpetual system, we'd have the second component to that, which would be cost of goods sold, the expense related to the inventory we sold, some amount less than the receivable, and the inventory going down, the assets going down. So we, of course, are focusing in on here this receivable amount and talking about what that means for us, what it means to the company, and are there some types of problems with receivables that we will have to deal with. And one major problem with receivables, and one that many people see when we start to learn the accrual accounting, we start to say, hey, we recorded a receivable here. If we're talking about balance sheet accounts, we say, for example, we have cash and we have total receivables of $45,000. Well, the cash is pretty concrete. We have that in the bank, and therefore there's not much question about the cash. The cash is cash. However, the receivable, many of us start to question in the accrual principle, especially when we start to first learn the accrual principle and say, hey, is it really fair for us to record this receivable of $45,000 when we have not yet gotten the cash? We're recording it as an asset, a current asset, almost equivalent to cash in some ways in the same section of the balance sheet as an asset when we don't have the cash yet. Can we do something about that? It seems like we might overstate the financial statements, and that's the question here. Will we be able to collect on this is the question with the receivable, the problem with the receivable. Just because we made the sale, just because we earned the revenue by doing the work completed, in our case giving the merchandise in order to complete the sales process and earn the revenue and therefore be entitled to the receivable, it is the fact and the case that some receivables won't be paid, and it'll differ from industry to industry. So that's what we'll talk more about as we go through future presentations. How can we value this? One way to do it is to have an allowance method and say, hey, this is the people that owe us money, how much is owed to us. We're going to estimate how much of that is not going to be collectible. We cannot write down the receivable directly because we don't know who's not going to pay us yet. But it would be reasonable to tell our readers, if someone's reading the financial statements, they would want to know the receivables. We got to put it on the books. We can't remove it. We can't be that conservative in that we're going to take it off the books and not recognize any assets at all. $45,000 of what is owed to us is significant. Readers to financial statements want to know that number. However, in order to be as fair as possible on the balance sheet side, we would also want to say, hey, we know that based on past history that it's likely that a certain amount of these receivables would not be collectible, and therefore the net receivables is what we really think should be recorded as an asset. And so we cannot write down the receivable directly. We don't know who's not going to owe us, but we can make this contra account, and that's what we'll talk about in the allowance method. There's also a problem related to the receivables on the income statement side of things, and whenever we talked about receivables, we talked about the debit to accounts receivable, and the other side of that is, of course, sales, when we record the revenue and the receivable. And we have the same question, or similar question, on the revenue side. Did we really earn this money? Is this sales, is this revenue that we recorded as earned when we made a sale on account for a certain time period? Is that really sales that we can record? In other words, it's not exactly a sale even if we delivered the goods, if we're not going to get paid in the future. And we need to question this on the income statement side, which again is another area where a lot of people, when we learn accrual accounting, we start to really question this. This question comes up a lot as to, well, how can we record a sale? Aren't we recording a sale that we may not actually actualize and therefore be overstating sales? And the same thing is the case here, that we have to record the sales because the readers of the financial statements do want to know that we earned the revenue by completing the work and therefore earned the revenue. However, we also need to tell our reader that, hey, some of those sales possibly will not be collected on, and therefore do a similar type of fashion on the income statement side, not only increasing the sales but also decreasing it with the amount of those sales that we believe are going to be uncollectible, something we typically call bad debt expense. So this would be dealing with the matching principle, so that the net income effect here we think should be something netted out between these two in order to be as fair as possible. Under the allowance method, this number here and this number here are just going to have to be estimates, which is another area of problem in and of itself, because estimates are estimates. There's a range and there's guesswork that we have to do there. But you can see why we would need to do these things, because we need to record the receivable, we need to record the sale, because those are important to the readers of the financial statement. We cannot eliminate it. We can't go to a cash basis and not record sales on account or accounts receivable. However, it would also be useful for us to try to look at past experience and give the actual number that we think is receivable on the balance sheet and that we think was actually earned on the income statement, and that will take a bit of guesswork. The other type of receivable we have is notes receivable. So a note receivable is going to be different from an accounts receivable in that it's typically a bit longer term in time frame, usually has a larger dollar amount, and therefore is often put in writing and often has interest then attributed to it. So an accounts receivable may not have the formal note documentation to record the transaction and the note, whereas the note receivable, we're typically going to have the formal note transaction because of the longer time period, the bigger dollar amount, and probably having the interest being charged on that. When we're considering notes receivable, we're going to consider notes receivable of time periods that are typically shorter than a year. When we're talking about our receivables here, they could happen for a couple different reasons. We might make a sale and we might have the period be a longer period and or more money, and therefore want a more formal documentation and or charge interest, and therefore make a note receivable rather than running it through accounts receivable. When we have a notes receivable, we're not going to put it into accounts receivable and track it in the subsidiary ledger to accounts receivable. We are typically going to have possibly our own account on the trial balance for each note that we make for each individual customer. Or we'll have a notes receivable account on the trial balance, and then we'll have the supporting documentation tracking the note receivable as well as the interest that will be generated from it. So a note receivable document will have something like this. We'll have the amount of the note receivable on the note receivable, the date of the note receivable, the date it was generated. So if we'll have the due date. So the due date might be formatted such as 90 days after the date of the note I promise to pay to the order of. And then we have the payee. So that's going to give the terms of the note, which is going to be 90 days in effect of the due date of the note. And then it's going to be paid to the order of the payee. Then we're going to have 1,000 no cents dollars for value received with interest at the annual rate of 10%. So in other words, we're typically going to have the principal amount, that will be due in some time period, 90 days in this case, from the date of the note to the payee, and then we're going to have the interest rate in this case being 10%. Then we're going to have the maker of the note's signature here. So when we think of the note, remember that the maker is going to be the one that you can think of as creating this note. If we had a business transaction, say the company sold something to a customer, then the customer would be the signer as the maker of the note. Now, of course, we would probably be the one as the business generating the note for the customer to then sign in that circumstance. But note that this is in essence a promise to pay. So you can think of this actually being written out by an individual making a promise, and that would be the person purchasing something would be writing out the note saying, you're giving me something of value, I'm purchasing something from your store, I'm going to write you a note here saying that I'm going to pay you 90 days from this time period, pay you, the payee, the amount of $1,000 plus 10% interest, and then signing the note as the customer then gives the note to the company or the store that is providing the good or service. So if we go through the terminology of this one more time, we can see that the amount here is going to be the principal. So when we consider the amount of a note, we typically consider it two components of it. When we get paid at the end of the time period, we're going to receive the original principal, and that's what we gave the customer in value. So if the customer purchased something for $1,000, the sticker price of what they purchased was $1,000, and they didn't give us money, they gave us a note, this note receivable, and therefore the principal of this note's receivable is the $1,000. We're going to get more than that because we loaned them that money. We in essence rented them the money, and therefore are going to also generate interest. So the final payment we will receive can be thought of as having two components of it. One, a principal component, and two, an interest component. And then we're going to have the due date. Now this is the date of the note up here. The due date is actually this item, which is the promise to pay within 90 days. And that does provide a bit of a complexity because when notes are worded this way, we do need to figure out when exactly that is. When is 90 days up? And make sure that we get the correct due date on the note. And then we've got, of course, the payee. The payee is the person who's going to get paid. And in our case, we're going to say that that's going to be the company. We're the company making the sale, receiving the note from the customer. Again, obviously, if you go in somewhere and you purchase something on account that you're going to get financed, and you go through the financing process, the company will typically help out with the financing process and be the one that generates the note. But you can think about this note clearly being a promise from the purchaser, the customer, to the store, the seller, in order to purchase something, a promise to pay. And so that means that the payee is going to be the person paid, the store providing the good or the service who is going to be paid the principal plus interest at the end of the note term. So this, of course, will be the interest amount being the 10%. Note what we have to do here with the note receivable. It's saying what the principal is, it's saying what the interest rate is, but it doesn't say specifically, one, what the actual due date is. It just says it's 90 days. We'll have to figure that out, and that's like the case with many notes, the way the note will be formatted and written. And that's for one reason, it makes it easier to formalize a note or make a standard note copy. If our standard note is 90 days, then it's easy for us to just say 90 days from whatever date the signature happens, and therefore we can have just a template of the note for that type of sale and make it pretty easy to do. And the interest rate will be the same type of concept. If we say that whatever the interest rate is typically 10%, then whatever the dollar amount, we can basically have the interest rate there. What we're not generating here is an amortization type table, or a table to show us the calculation of interest that will be due at the term or the end of the note. And also note that we could have many different types of notes set up. This is going to be a fairly simple type of note where we're going to pay simple interest and the principal at the end of the term period, at the end of the 90 days. We could make a note as complex as we want. We could make a note that pays a monthly type of note. We can have the compounding of interest be different. So note that the complexity of a type of note can differ greatly. But at the minimum, we're going to need these components typically in a standard note in order to create a standard note. And oftentimes when you look at the note, it doesn't give the total amount that will be due at the end of the note term. It only gives you the interest rate, it gives you the principal, and it gives the time frame for the note. And therefore, we're probably going to want to go through the process of figuring out what is actually going to be due at the end of the note, which of course will be the principal amount plus some type of interest. Now then, of course, the maker of the note, once again, is going to be the person who is promising to pay. So this is the person who is signing the note and therefore promising to pay for services rendered or goods rendered. So if we purchase goods and we're the customer, we purchase goods, we got something of value of $1,000 in terms of goods and services. We're making this promise to pay back that amount some point in the future. Hello, in this presentation we will be recording journal entries for business transactions related to accounts receivable, otherwise known as the revenue cycle. We will be recording these using debits and credits. At the end of this, we will be able to list transactions involving accounts receivable, record transactions involving accounts receivable using debits and credits, and explain the effect of transactions on assets, liabilities, equity, revenue, expenses, and net income. We're going to be recording these transactions up here on the left-hand side, constructing those journal entries in accordance with our thought process, our list of questions to most efficiently construct the journal entries. We will then be posting them not to the general ledger, but to this worksheet here so that we can see the quick calculation of the beginning balance and what is happening to the individual accounts, as well as account types, in that we have the accounts categorized, as is the case for all trial balances, accounts being in order, that order being assets, in this case in green, the liabilities in orange, the equity, light blue, and the income statement accounts of revenue and expense type accounts. First transaction, performed work on account for $10,000. First question we will always ask, is cash affected? In this case, no, we didn't get cash, and the key term here is on account. Be aware of that key term. In real life, we would know what would be happening here, meaning we did work. If we were a bookkeeper, we did the bookkeeping, and then we sent out the bill. Have not yet received the cash. In a problem that's in a book, they have to indicate that in some way, often a very generic type of thing here where we're just a service company and we did work, and the key term being on account. On account will mean either accounts receivable or accounts payable. When working with the accounts receivable or sales cycle, as we are here, the account when you see on account will be accounts receivable. Some books might use the term on credit, and in practice you might hear the term credit. The reason many books avoid that term is because we don't want to confuse it, or the book doesn't want to confuse it with the idea of debits and credits, mixing up the meaning of what a debit and a credit is. But when you hear that term in real life, you gotta know what the distinction is when someone says they're gonna have something on credit versus debiting and crediting the account within a journal entry. If cash is not affected, then we're going to ask, what did we receive? And what we got in this case is an IOU. We got people owing us money. We got a promise to pay at some point in the future. That's going to be our accounts receivable account. It's our second favorite asset account. Not as good as cash, but we like people owing us money. It therefore, because it's an asset, has a debit balance. We need to make it go up because people owe us more money. So how do we make an account go up? We do the same thing to it as its normal balance. It being an asset, having a normal debit balance means we will do the same thing of another debit. So we're going to debit the accounts receivable, and that means we are going to have to credit something for the same amount. Why are people going to pay us $10,000 in the future? Because we did the work today. We performed the work today and therefore earned revenue or income. The credit going to revenue or income. We already know that if we know that it's going to be revenue or income, that we will be crediting it because we debited the accounts receivable. but we want to think through that. Remember that revenue is an income statement account, revenue and expenses being the income statement accounts, and income statement accounts only go in one direction. Revenue accounts going up in the credit direction. Therefore, we're going to do the same thing to it, which in this case is another credit. Also note that according to the revenue recognition principle, we're recording revenue here when the work was done, although we have not yet received the cash. And typically this would be like an invoice transaction. The transaction would be recorded when invoicing the client, as is shown here. So if we post this out, we're going to say that the accounts receivable goes from 0 up in the debit direction by 10,000 to 10,000. The revenue starts at 0, goes up in the credit direction by 10,000 to 10,000. Remember here that we are representing debits and credits in 2 columns, and the credits with brackets on the journal entry, but when posting, we're showing the credits as bracketed numbers only, not in a separate column, and debited numbers without brackets. This will save a lot of room when we post to a worksheet like this, and that's why we will be working with this in practice. It will save a lot of time. If you're working with Excel, which I highly recommend doing, then it'll save a lot of functionality in the formulas as well. The effect on the accounting equation: assets increasing as cash goes up, liabilities remaining the same, and equity going up because net income is going up, net income going up because revenue is going up, net income calculated as revenue minus expenses, net income increasing equity. Here we see that net income is increasing due to revenue increasing, net income starting at 0, going up by that 10,000, calculated as the 10,000 minus the 0 minus the 0. Remember that brackets does not mean negative number for us when considering this in the format of debits and credits. It represents a credit. It represents revenue over the debits, the credit of revenue over the debits of expenses by net income of 10,000. Next transaction: receive cash on account 10,000. First question we're going to ask, is cash affected? We're going to say yes. We're going to say received cash. Is it going up or down? Up. Keyword received. How do we make something go up? We do the same thing to it as its normal balance, which in this case would be a debit to an asset account which has a debit normal balance, increasing cash. Now, when first seeing this, many times when we start working with journal entries, we start to think, wait a sec, is cash really affected in this? Because I also see the key term on account. And I start to think that when I see on account, that means cash isn't affected. It means that some other accounts receivable or payable thing is happening here. And when we are purchasing something on account, that will be the case, because we purchased, in the last example, we purchased something on account, or in that case, we did work on account, and therefore the on account was affected rather than cash. But in the second half of that transaction, what's happening is we're going to receive cash for the amount that was owed to us, in this case what was in the on account of accounts receivable. So bottom line, don't let that throw you off. If it says received cash, then we received cash. Think about that first, and then we'll think about why did we get cash. We got to credit something. What are we going to credit? We can't credit revenue because it says on account, and that indicates that we didn't do the work at this point in time. That indicates that we did the work sometime in the past. And if we see this transaction without having first seen the prior transaction, we've got to be able to look at this and say, what must have happened in the past? What must have happened in the past is that prior transaction. That's how the accounts receivable works. We do work on account. We invoice the client. We put that money into this account called, or that receivable, that IOU, into this account called accounts receivable. It represented here with this 10,000. Now once we get paid, that 10,000 needs to decrease. So the credit is going to go to that accounts receivable. It's going to reduce that 10,000 back down to 0. So if we post this out, we see the 10,000 debit to cash, increasing cash from 0 up by 10,000 to 10,000. Accounts receivable then going down with a credit, it being a debit account. We doing the opposite thing, crediting it, bringing that balance down to 0. The effect on the accounting equation, assets going up, however, assets also going down, one asset increasing, one asset decreasing. In essence, we're getting a better asset and losing the worser asset. We're losing the fact that people owe us money and getting the fact that we have now got the money. There's no effect on the liabilities and no effect on equity. If we look at the net income, no effect on net income. Note that although we got the cash now, we already recorded the net income in the past, and therefore in the current transaction in the middle column, nothing's happening to net income, and we are remaining at 10,000, representing net income calculated as revenue minus expenses. We are now able to list transactions involving accounts receivable, record transactions involving accounts receivable using debits and credits, and explain the effect of transactions on assets, liabilities, equity, revenue, expenses, and net income. Hello, in this lecture, we're going to talk about the accounts receivable subsidiary ledger. The subsidiary ledger being the ledger that will be backing up the account of accounts receivable shown on the trial balance with $27,000 in it. In this case, accounts receivable being that account that represents what is owed to us. If we were the owner of the company, we might ask our accounting department, how much money do people owe us? In this case, it would be $27,000 would be the reply. Next follow-up question would most likely be, who owes us that money? And have we called them? When are we going to get paid that money? In order to answer that question, we cannot look at the normal backup balance for all accounts, that being the general ledger account. If we look at the GL, we do get some detail in terms of the activity that has happened. However, that activity is not going to be in terms of who owes us the money, it's in terms of date. So every account has the general ledger, which does give very good detail, but not the detail we need in this case. What we will then need is that information broken out by customer, which will be in terms of a subsidiary ledger such as this. For example, it might say that Smith owes us $5,000 and Ryan owes us $15,000 and Adams owes us $7,000 for a total of the $27,000. The accounts receivable subsidiary ledger matching the general ledger, matching the trial balance, which of course would match the balance sheet. It's important to note that this information is all put together using the same data. So the general ledger is often thought of as how we create or put together the information which the end result will be reported in terms of the trial balance. We can put that same data, the same general ledger data, into the subsidiary ledger. That's what we'll do in this process. Also important to note that because of that relationship, when we look at the end result, meaning the accounts receivable account in terms of the trial balance or the balance sheet, we can sort that data and back up that data in terms of a general ledger or a subsidiary ledger. Let's take a look at some transactions. First transaction is a familiar one. We've seen it before. We're going to invoice the client, so we're going to do work on account. Therefore, accounts receivable is going to go up, the IOU is going to go up with a debit, and we're going to credit the income account. I'm going to post out the income account. I'm not going to post it to the general ledger account. It would have one, but we want to focus in on the GL for the receivable. So if we post out that income first, income would increase, increasing revenue for that time period when the invoice was issued. Accounts receivable, we're going to first post to the general ledger. So the general ledger for accounts receivable increasing by that $35,000, which would then increase the total in the accounts receivable GL to $35,000. And of course, the same would impact on the trial balance, increasing the trial balance to that $35,000. We can see then that after this journal entry, we have $35,000 in accounts receivable, we have $35,000 in the general ledger, but we also want to see that information in terms of who owes us the money. And in order to do that, we have the subsidiary ledger broken out by client, by customer, and we want to post this same information, that same $35,000 to the information by customer. So it's the same as the GL, except it's a bit more detailed in that it's by customer and then by date. And if we post that out, we see the $35,000 is owed by Smith. Now we have a total in the subsidiary ledger of $35,000, total in the general ledger of $35,000, as well as in the trial balance and what would be on the balance sheet of that $35,000. That relationship always has to be there. Next transaction, we're going to assume that we paid. So the customer then paid us. We're receiving cash. Cash is going to increase, and we're going to credit the accounts receivable. Not revenue, because we didn't do the work. We did the work last time. We're crediting the receivable. So one asset's going up, one asset's going down. I'm going to post the cash first because I don't want to focus on the cash. We're not going to be looking at the GL for cash. I'm just going to say cash is going to be a debit increasing the cash. And then we'll focus on the receivable, which we will post to the general ledger. So that's going to bring the balance down. We can think of that in two ways. One, the running balance, 35,000 debit minus the new activity, which is a credit, bringing the balance down to 0, or summing up the debits, 35, summing up the credits, 35, debits minus the credits would then equal 0. Same activity, same thing would happen to the trial balance, bringing the trial balance down to 0, meaning trial balance now at 0, general ledger now at 0, subsidiary ledger need that same information. So we're just going to post that same information on the GL. It's the same thing that will be impacting the accounts receivable subsidiary ledger. However, it will be there by client or customer, bringing that balance down. We are back down to 0 on the subsidiary ledger for AR and the general ledger for AR and the trial balance for AR. New customer. We're saying new customer. We're going to invoice a new customer. We did work. Invoice goes out. That means debit accounts receivable, credit the revenue account. We're going to post the revenue first again because we're not really focusing on revenue. So although it has a general ledger account, like all accounts do, we're just going to post it to the trial balance, increasing revenue. Then we're going to focus on the receivable. We're going to post that out to the GL. What would that do to the GL? Debit to the GL, the general ledger for accounts receivable, going up by that 14. That would bring the balance up to 14, calculated in one of two ways. We can say it's 0, running balance was 0 before, plus a debit, bringing it up in the debit direction, or we can say the debits, 35 plus 14, minus the credits of 35, bring us to the 14. Same thing would happen to the accounts receivable up here. So we're saying accounts receivable for the trial balance is going up to 14,000. Now we see that we have 14,000 in the trial balance for accounts receivable. We see we have 14,000 in the general ledger for accounts receivable. And we need to post that same 14,000. This same 14,000 needs to be posted to the subsidiary ledger, but by customer in this case, and that customer being Adams here. So Adams is going up by that 14. Now we have 0 plus 14 plus 0 brings us to that same 14. The subsidiary ledger tying out to the general ledger, tying out to the trial balance. Then we're going to have another invoice. We're invoicing another customer. Same thing, we did work invoicing the customer. Accounts receivable is going to go up with the debit of that 27,000. We're going to credit the revenue. Again, I'm going to post the revenue first, not to the general ledger, although it does have a general ledger account, but we're not focusing on the GL for this particular account. But revenue would then increase in the credit direction. Now we'll post out the receivable. It's going to be another debit to the receivable. In this case, increasing the receivable, we can think of that two ways. The 14 prior balance plus the 27,000 current activity brings it to the 47, or 35,000 debit plus 14,000 debit plus 27,000 debit. That total minus the 35,000 credit total would also bring us to that 41,000. That's the T account format, and this is the running balance format. If we post it out to the trial balance, we see the same activity, the 14 plus the 27, bringing us to that 41,000. We can see that then the 41,000 on the trial balance is equivalent to the general ledger account for accounts receivable, 41,000. We need to post that same 27,000 to the accounts receivable subsidiary ledger, but by customer, that customer being Ryan in this case, bringing the balance up to 27,000. Now we have a balance of 41 total, including the 14,000 Adams, 0 for Smith because Smith paid off the balance, and 27,000 for Ryan. Point being that subsidiary ledger is the same data in essence as the general ledger. It's just posted in a bit more detailed of a fashion. We want to be able to know that relationship so that we can, one, build the trial balance, and also we need to know it so that if we are using software, we know that we can sort this data, one by GL, by date, but also by customer and then date. And that's also why much of the software, when we work with accounts receivable, will require a customer every time we post to the receivable. The software saying, hey, I can't make a subsidiary ledger unless you assign a customer. Therefore, we're not going to let you post to the receivable account unless you assign a customer. In this presentation, we will be discussing the direct write-off method. The direct write-off method as it relates to accounts receivable. Quick summary of accounts receivable. Accounts receivable is a current asset. It's an asset with a debit balance. we are going to be writing off certain amounts for accounts receivable that will become not due or not collectible at some point in the future. There are two ways to do this. One is called the allowance method. The other is the direct write-off method. We will be using the direct write-off method here, the non-generally accepted accounting principles method being this direct write-off method. However, a method that is typically much easier to use. Therefore, when considering whether or not to use an allowance method or direct write-off method, we want to consider, one, do we have to use an allowance method due to the fact that we need to make our financial statements in accordance with generally accepted accounting principles, or are we able to choose between having an allowance method or a direct write-off method? If we choose to have a direct write-off method, it's probably because we're thinking that the receivables that will be written off are not significant. In other words, they're non-material to decision making. So if we had our accounts receivable here, that's what people owe us. We want that on the books to represent the fact that we do have an asset. We do have people owing us this money. However, if there's a significant amount that we believe will not be paid to us, then we want to note that if we don't, we're overstating our assets and we're also distorting our net income on the income side of things. So the deciding factor then is going to be, one, do we have to use an allowance method? That will be a generally accepted accounting principle. If we have to make financial statements in accordance with the strict generally accepted accounting principles, then we would typically need an allowance method unless the amount was immaterial. If we're not required to be recording our books with regard to the allowance method because of generally accepted accounting principles, the question then is, should we be recording the allowance method? Is it better for decision making? That decision basically again coming down to whether or not it's going to be material to decision making, how many of those receivables we believe will not be collectible. As we go through the direct write-off method, we always want to compare it to the allowance method to see the differences between the two methods. We have this account here, this red account, that will not be used as we go through this direct write-off method, but there to show us what would be there if we were to use an allowance method to compare and contrast as we go through this process. So first we're going to say that a customer CW is not going to pay us the accounts receivable of $9,000. For whatever reason at this point in time we've decided we're not going to get paid, and therefore we're going to have to decrease our accounts receivable. And the decrease is going to be a credit to accounts receivable. Accounts receivable is a debit balance asset account. We're going to do the opposite thing to it to make it go down because we're not going to get paid. Therefore, our journal entry will be a credit to accounts receivable. That will be the same under the allowance method or the direct write-off method. The other side is what will differ. Under the direct write-off method, we will write it off to bad debt expense. This is probably what seems most natural at this point in time because it's not getting paid, so we're going to write it off to bad debt expense. What actually happened here? How did that accounts receivable get on the books in the first place? We debited accounts receivable and we credited revenue when we made the sale. You would think then that we would decrease revenue at the point in time that we discover that this sale, $9,000 worth, is not valid. We're not going to get paid that $9,000. But we don't typically reduce revenue, one, and therefore we're going to make this other account that's going to kind of be like a contra revenue account because we never really earned the revenue, bad debt expense. So it's going to be an expense. We're really kind of taking away revenue that we had recorded in the past. Now the problem with this method, of course, is that when we record this expense, we will be reducing net income at this point in time when really the sale that happened that increased revenue happened in the past. So it's a timing problem that we have, not so good timing in terms of the direct write-off method here. Let's see if we post this then. We're going to post this to the general ledger accounts here, then we'll record it to the subsidiary ledger. So we're going to say that the bad debt is going to go up. Here's the general ledger, just the two accounts. We're not going to show all the accounts for the general ledger. Every account here on the trial balance would, of course, have a general ledger account showing the detail by date. That means it's going to go up from 0 by 9,000 to 9,000. That's going to be the new balance. Here's the accounts receivable. It started at 1,200,000. There's the 1,200,000. Well, it was 1,200,000 before this. Now we're going to bring it down by the 9,000 to 1,191,000. There's the 1,191,000 now on the trial balance after this transaction has happened. We also need to record this to the accounts receivable subsidiary ledger. So we know that CW is the individual that didn't pay us. We note that the accounts receivable over here on the trial balance and here on the general ledger show who owes us money, how much is owed to us. The GL gives us detail, but only by date. The subsidiary ledger would then give us detail about who owes us this money. We're just going to show the account for CW here, but in a subsidiary ledger, we would be having all of the accounts owed, all the customers owing us money, and if summed up, then it would add up to the amount on the trial balance. So in this case, CW owes us that 9,000. We're going to say that they're not going to pay us. We're going to take it out of the subsidiary account, and that will bring it down to 0. Note the major problem and difference here between the two methods is that under this method, the direct write-off method, we brought net income down by this 9,000. We had revenue 378 minus this 9,000 we just recorded, bringing net income, the subtraction of those two, to 369,000. Under the allowance method, we would have recorded that to the allowance account that we would have already set up, not decreasing net income at the point in time that we determine that something will not be due, but having already done so or estimating what the decrease will be, trying to match up the bad debt expense to the revenue that it was actually incurred in, rather than waiting until we determine when something is uncollectible. Note that we have a lot of control over net income in some ways if we're able to then decide when we think something is going to be a bad debt, because we can write things off at certain times or wait and not write them off, and that can have a significant influence on the net income. On the other hand, if we are forced to basically make an estimate of how much we think of this revenue will be uncollectible, then we're at least have to give a guess as to what we think a fair number would be that would be uncollectible related to the revenue earned during this time period. Next transaction, we're going to say that G company had a payment of $20,000 but owed us $30,000. In other words, of this receivable, this $1,191,000, G company owes us $30,000, but they're going to go bankrupt or something happened. We're only going to get $20,000. We're not going to get the rest. We can imagine they grow and bankrupt. We're going to get $20,000 in the bankruptcy. The $10,000 is something that we're not going to get. We're going to write it off. Therefore, we can say, okay, cash went up just like a normal payment on account. Cash has a debit balance. We're going to make it go up by doing the same thing to it. Another debit, $20,000. Then we're going to credit the accounts receivable. The account here, of course, saying that they owe us money. It's going to go down because they don't owe us money anymore. This is a debit balance account. Therefore, it goes down with the opposite of a debit or a credit. However, we're not going to credit the $20,000, but the $30,000, the total owed to us, so that we totally remove the amount that's owed to us off the books. Our debits do not equal our credits now. We need a debit of $10,000. That then is going to go under the direct write-off method to bad debt expense. This is what will differ under the two methods. Under the direct write-off method, it goes to bad debt expense. Under the allowance method, it would be going to the allowance for doubtful accounts. So this is going to be the same type of transaction we had before, only difference being that we received a partial payment. So don't let that throw you off. If you see a partial payment, then we're still going to go through our normal transactions. We're going to say, is cash affected? Yeah. We're going to increase the cash. Then just note that you have to take the receivable off, but not for the amount received, but for the entire amount, because we're not going to get the rest, therefore needing to remove the full amount owed by this customer, so we don't show that they still owe us $10,000. They don't owe us anything anymore because we gave up on the other $10,000. Then we have to decide how we're going to even this thing out. We do so with another debit. If we then post this to our general ledger accounts over here and our subsidiary ledger, and then we'll take a look at our ending trial balance, we're going to say that cash is going up from $100,000 by this 20. So we post that to the GL account, increasing the GL to $120,000. That, of course, will now match our trial balance after we post that. Then we're going to say the accounts receivable, this 30,000 credit, we had 1,191,000 here. It's going down by 30 to 1,161,000. That then matches what will be on the trial balance. Then the bad debt here, the thing that will differ, the bad debt changing as we determine that something will not be collectible, going from 9,000, here's the 10, here's the 10, going up by 10 to 19,000. That then the amount in the bad debt on the trial balance. Note once again that the revenue is going, the net income is going down. Bad debt's going up, is bringing net income down. That's going to be a difference. That's the major difference between the direct write-off method and the allowance method. Under the allowance method, this journal entry would not be affecting net income. Net income would only be affected when we make an estimate about what the bad debt should be, not based on when it is becoming bad, but based on matching it to the revenue in the same time period. And we could do that with two different methods we'll talk about in a later point, but remember that the allowance method should have a better matching principle between the revenue and the bad debt happening in the same time period. Then we have the accounts receivable subsidiary ledger. Remember that the accounts receivable here represents how much is owed to us, but doesn't give us any more detail than that. The accounts receivable here gives us detail, but only by date of transaction. We need the detail by who owes us money. That's going to be the accounts receivable subsidiary ledger. We're only going to look at this particular customer here, this customer G company, but all the customers, remember, would be included in the subsidiary ledger. If we added up all customers, it would then add up to the accounts receivable on the trial balance and on the general ledger. We're going to say record the same thing. This 30,000 goes here, and that's going to bring the balance down to 0. So that's critical. We know that G company doesn't owe us any more money. They paid us 20, even though they owed us 30. We took the entire 30 off the books, not leaving that 10,000 still owed to us because we gave up on it, and therefore need to take the entire 30 off the books, bringing them down to 0. Next transaction. We're going to say received a payment from CW after writing it off. This is going to be a typical book type transaction, not so typical when we have a real life situation, because if we wrote off the bad debt, we totally gave up on it. So we gave up on the bad debt, and then and that doesn't normally happen until we go through a pretty significant collection process. And then after we gave up on it, we're not calling anymore, we're not actively trying to collect on it. It then gets paid at some point in the future. How do we deal with that? That's a great book question because it really emphasizes the difference between the two methods and how are we going to kind of reverse this transaction. Now this is going to be the trickiest thing that we have here, because typically if we got paid, you would think that we would debit cash and then we would credit what we know we wrote it off to bad debt. So you would think, okay, well, I wrote it off to bad debt, I can just credit bad debt. So typically we would go through our questions. Is cash affected? Yeah, I debit cash. And then the other side can't go to receivable because I wrote it off. Well, where did we write it off to? Bad debt. So we could debit cash and credit bad debt. However, we're not going to do that, and this is kind of an exception to the rule of dealing with cash first. And that is because if we do that, we bypass the accounts receivable, and we don't have a record showing us that in the receivable account, in the subsidiary ledger for this customer, that they actually paid it. What we want to do is put them back in good standing on the receivable account and then write it off as we normally would. Therefore, we're going to do this with two transactions, two entries. We're going to put them back on the books. We're going to say the receivable is going to go back up. We wrote off the receivable. We're reversing the write-off. And then we're going to put the other side to bad debt expense, meaning when we wrote it off, we credited the receivable to take it down, and under the direct write-off method, we put the other side to bad debt expense. We're just reversing that now. We're going to put the debit to accounts receivable and the credit to bad debt, just reversing the write-off that happened because it didn't really happen because they actually paid us, so we gave up on them too soon. Note that this bad debt expense is part of the reversal and part of the difference that would be between the two methods. Under the allowance method, this amount would have been written off to the allowance and therefore would be reversed now to the allowance. Once we do that, then the second piece is easy because it's our normal transaction. We got paid on account. The accounts receivable is back in good standing. Therefore, we're going to say it's cash affected. Yeah, it's a debit. We're increasing cash with a debit. So it's a debit to cash, and then we're decreasing the receivable, which we just increased, by the 9,000. So again, we could simplify this transaction. You can look at this and say, hey, we're duplicating information. I mean, I've got accounts receivable here, and I've got accounts receivable here, and it's just doing the same thing. One's being debited, one's being credited. I could eliminate those two. If we just eliminate these two, we would be left with a debit to the checking account and a credit to the bad debt. The problem, once again, is that we want to see the paper trail in accounts receivable. We want to be able to go to the accounts receivable subsidiary ledger and say, yeah, this person paid us. We're willing to do business with them in the future. We can't see that if we don't reverse the transaction and then put it through the subsidiary ledger. Let's take a look at recording this then. We're going to say first the accounts receivable is going to go back on the books. So we took them off the books here in the subsidiary ledger, back on the books in the receivable, increasing the amount to 1,170,000 here. Other side, and that's all that's there right now. Other side, it's going to go to the bad debt. Bad debt is being reversed here. So here's the bad debt that we wrote off incorrectly. We gave up on it too soon. We are reversing it here at this point in time, bringing the 19 down by the 9 to the 10,000. Then we're going to record the second piece, which is just the normal transaction for a receipt on account, receiving money for the accounts receivable for something that we did in the past. So here's the cash going up, here's the cash going up, and that brings the balance from 120 to 129. And then the other side of it is going to be the accounts receivable here. It's going to be the credit. Here's the credit. So note what happened. We started before this process in the receivable general ledger at 1,161,000, and then we brought it up, putting them back in good standing and back down to bring us back to that same spot, 1,161,000. We'll see that same process in the subsidiary ledger. The subsidiary ledger for CW, remember, we had 9,000. We gave up on them, wrote them off, leaving us at 0. And then ignore this 9,000 here. We're at 0 at this point in time. And then we have the other side of it is going to be a debit to the accounts receivable. So the accounts receivable is going up with this 9,000, putting them back on the books. So we took them down to 0. Put them back on the books at 9,000, bring us back up to a 9,000 balance. That's from this transaction. And then we're just going to take it right back off the books for the accounts receivable for CW here. So CW, another 9,000, bringing the balance back down to 0. So if we look at the subsidiary ledger, remember that this would be a subsidiary ledger with every account for every customer. However, we're just looking at CW's subsidiary ledger. They had 9,000 owed to us. We wrote it off in the past prematurely. We should not have done so because this was still a good customer. They just paid late, very late apparently. And so we brought it down to 0, and then we want to see that we put them back in good standing here so that we can see the paper trail, bringing them back up to owing us 9,000, and then we record that they paid us. If we look at this payment then, it still brings us down to 0, but we can look at this payment and say, well, how did we get paid, and see that they actually gave us money. Whereas if we looked at this transaction and we just left it here and we didn't record the other two, we would drill down on that transaction and say, well, they didn't pay us. And that would probably stop us from doing business with them in the future. We want to say they're back in good standing and they paid us here, therefore we can still do business in the future. Note the effect here is going to be on the bad debt. The bad debt is now going down, and that's going to be a difference between the allowance method and the direct write-off method, where the allowance account would be the account affected. There would be no effect to the net income or the income statement accounts at all under the allowance method, whereas under the direct write-off method, of course, bad debt is affected, and it would then bring bad debt going down, bringing net income up. Hello, in this presentation we're going to take a look at the allowance method, which is of course related to the accounts receivable account. We will be able to define the allowance method, record transactions related to recording bad debt, recording a receivable account that has been determined to be uncollectible, recording a receivable account that has been collected after being determined that it was uncollectible. So we're going to take a look at some different transactions, the most common transactions when dealing with the allowance method, and see what those look like and why we use the allowance method. We're going to work through a problem. So what we're going to have here is we've got our accounting equation, of course. We have our trial balance. I do suggest working problems to take a look at a trial balance because it can give you the context in which to work problems. So here's what we have. We've got the assets in green. The liabilities are going to be orange. The light blue is the capital account and the equity section. And then we have the income statement in the darker blue, which is going to be the revenue and the expenses. We can see in this example, we have net income. The net income is going to be calculated as revenue minus expenses. We don't have any expenses at this time. We're just going to note this revenue number so that when we work through the problem, we can see what the effect is on net income. Note that we're representing debits with positive numbers or non-bracketed numbers and credits with bracketed numbers. That allows us to have lesser columns and use this quick worksheet to calculate the balancing of the debits and the credits by having the debits minus the credits equal 0. So that's what we have here. We are going to be focusing in on the receivables section, of course, and we're going to post transactions to this trial balance to see the adjustment in relation to the trial balance. Then we'll also look at the accounts related to the receivable account. So oftentimes we'll take a look at the general ledger. There's going to be a general ledger account, of course, related to all types of accounts. All accounts on the trial balance will have a general ledger account, which will be in order by date. We're only going to look at the two general ledger accounts that we're going to be working with in this problem, being accounts receivable and the allowance account. So those are the two we're going to look at. Of course, just keep in mind that there's going to be other general ledger accounts for all of the accounts on the trial balance. Then we're going to take a look at the accounts receivable subsidiary ledger. So remember that the subsidiary ledger is going to give the same detail that's basically in the general ledger. However, instead of just breaking it out by date, it's going to break it out by customer who owes the company money. So remember the questions that will happen in relation to the receivable. We're going to ask, well, who owes us? Do people owe us money? Yeah, people owe us $1,200,000. Who owes us money? For that, we go to the receivable account. So we just got these generic names. These are our customers: G company, D company. G owes us 30. BD owes us 8. CB owes us 0. KT owes us 3,000. M owes us 4. CW owes us 9. P owes us 6, 7, and all other vendors. Note that this thing are customers, all other customers. Note that this thing could be very long. This subsidiary ledger could be very long, and we could have a professional accounts receivable employee just tracking this information, which would be dealing with this report a lot. All other customers add up to 1,139,300, and that means that if we add all those up, it adds up to 1,000,002. So note that the receivable subsidiary ledger ties out to the general ledger, ties out to the trial balance. Now the new account we have here will be the allowance account here. So now we have an allowance account. Note that it's still green, it's an asset account, but it has brackets, meaning it's a credit balance account. So it's a contra asset account. It's an asset account that has a debt credit balance, which is contra to the norm, which is normally a debit balance in asset accounts. So the question, many times when I teach accrual accounting to new students, they often think that the way we recognize revenue is overstating revenue under an accrual basis, because when we do work on account, we're going to increase revenue and we increase the assets by increasing debiting receivables and crediting revenue. And if we haven't received the money, there could be a valid argument to say, well, yeah, we did the work and you can say we earned it, but it could very well be that we never get the money. And if we're recognizing revenue at the point of sale before we get the money, then isn't it true that we're probably going to be overstating revenue by those revenues that we're not going to receive in cash? And isn't it true that the accounts receivable is going to be overstated by the amount that we're not going to get? You're reporting this asset of $1,200,000 on the books, pretty large asset. Are you sure you're going to get all that? Aren't we overstating? And isn't there a generally accepted accounting principle that basically says that we want to be error on the conservative side? Meaning, when we talk about conservatism, in this case, we don't mean political conservatism. We mean that we'd rather err on the side of looking kind of worse, meaning assets being understated and liabilities being overstated. rather than the other way around, because from a generally accepted accounting principle, these statements are being geared towards outside users, being stockholders and creditors, and we don't want to overstate our position to them. So you can see from a regulatory body, they would rather us err on the side of understating the receivable, and it would seem that the accrual method does the exact opposite. And it's not till this point that we can kind of talk about how the generally accepted accounting principles deals with that. And the way they deal with that is they say that we need to account for that. We need to say, hey, you know what? Yeah, people owe us $1,200,000, but we believe that in this case, $40,000 is going to be uncollectible. How do we know that? We're going to talk a bit more about that towards the end, but the general idea, the general principle will be that we need to tell our readers that we believe that certain amount is going to be uncollectible. So if it's going to be significant, if the amount is significant, the generally accepted accounting principles requires us to use the allowance method rather than the direct write-off method. The allowance method is this method we're looking at here, which says that we're going to have to report the amount of the receivable that we think is going to be uncollectible. So under the direct write-off method, by contrast, what would happen is, for example, if this individual CW company could not pay, if CW company went bankrupt or whatever, we determine that this company's not going to pay us. When they come to us and tell us, okay, we're not going to pay us, we're going to look at their accounts receivable and say, all right, yeah, they owe us $9,000. We need to make that go down. So the receivable account is going to go down when that happens. Under either method we use. We know we got to take it out of the receivable because we have now determined we're not going to receive it. Therefore, we're going to credit the receivable. Where should the debit go? And if you think about it, what really happened if we're not going to get paid by a client or customer, it means that we overstated revenue at some point in the past. In the past, we overstated revenue because we increased revenue by a sale that's not really going to happen. It's not really a sale if we're never going to get paid for it. So you would think that the debit would go to revenue, which would reduce revenue because we overstated revenue. There's a couple problems with that, however. One is that we don't like to decrease revenue directly. Remember that revenue basically always goes up, and we almost never debit revenue. So therefore we make another account. That other account's going to be called bad debt expense. So the expense is going to go up, which brings down net income. So under the direct write-off method, that's what would happen. We would take it out of the receivable, and we would record the expense when it is determined that the client's not going to pay us, and we wouldn't have this allowance account at all. We wouldn't have it here, and that would be a fairly simple method. That's the easiest method to do. If the receivables are immaterial in decision making, then we can't use that method. But if the receivables are material, there's another problem here, and that is that note that if we write off this $9,000 that we wrote into revenue last year, it was part of revenue last year, and we're writing the expense related to it, or the reduction in net income this year, then we're violating the matching principle because we're reducing it in relation to this income, but the $9,000 isn't included in this income. It's not included in this $378 because it was earned. We recorded it in income last period, and we already closed that out to the capital retained earnings account. So that means that's the problem. So under the accrual method, what we want to do is match the expense with the revenue. So we want to look at the same time period and say, okay, I'm gonna say that this amount is going to be uncollectible in relation to this revenue, and that's going to be an estimate. So we had to make an estimate and do that. We'll talk more about how the estimate will work later, but just note that at the end of last period, we made an estimate and we said, okay, of the $1,200,000 that is outstanding, we believe that $40,000 is not going to be collectible. And now when someone comes to us and says that they're not going to pay us the $9,000, then instead of debiting the expense at that point in time, we're just going to debit the allowance. So it would look like this. So under the allowance method, when a customer is determined that they will not pay us, then we're going to reduce the receivable with a credit. The debit will go to the allowance account. What will that look like in terms of the trial balance? Well, we can see here that the receivable is going to be credited, so that's going to go down. So obviously that has to go down. And all we're going to do on the other side is we're just going to debit the allowance. The allowance has a credit balance. We're going to debit it, doing the opposite thing to it. which will make it go down. Notice that the book value of the receivables, the net value, is going to be unchanged because it was before 1,000,002 minus the 40. That's the net value. And now receivables went down, and so did the allowance. So therefore, now it's the 1,091 minus the 31. So notice there's no effect on net income down here, and that is because we basically already wrote off this 9,000 included in the 40,000 last time period when we created the allowance account, and we'll do that again at the end of this presentation. So you can see if we go through our series of questions, then we're going to ask, well, do people owe us money? Yeah, the trial balance says that people owe us 1,191,000. Well, who owes us some money? Well, if we look at the GL account, it doesn't tell us that. If we look at the GL account, it just tells us by date that we had 1,000,002 and it went down by 9. If we look at the GL account for the allowance, we can see that that's basically telling us that this was an amount that was not paid, and we had to write it off even though we were not paid for it. And then, so we're going to have to look at the subsidiary ledger, which is in order by customer. So if we look at the customer in this case, we're going to say that CW is the one that we are writing off. So this 9 here is also recorded here, and it's also recorded here. So this is the same information that is now recorded in terms of customers. And then if you take that off, now CW owes us 0. And if we add up all the customers, then it adds up to 1,191,000. Those are the people that owe us money. That ties out to the general ledger. That ties out to the receivable account here. And note that we have 31,000 that we do not believe is collectible. We cannot apply that 31 to any of the actual customers because it's just an estimate. We don't know who's not going to pay us. We just believe that a certain amount of folks aren't going to pay us based on prior experience. So now we have G Company made a partial payment and went bankrupt. It is determined that we will not receive the balance. So we're going to receive 20,000 of cash, and then we're not going to receive the other 10. So if we look at G here, we can see that the company owes us 30,000. They're going to go bankrupt, and they're within the bankruptcy, assuming they paid off who they could, which they paid off us 20, and then they're not going to pay the rest because they went bankrupt. So that is what's happened. If we go through our series of questions, then we can say, well, is cash affected? In this case, it is. We got 20,000. So we're going to increase cash. It's going to go up in the debit direction by 20. Normally, when we get paid, the normal credit will go to, in this case, receivables, because that's why they paid us. They paid us to pay off the receivable. So the receivable has a debit balance. We're going to make it go down by crediting it. However, we're not going to credit it by the 20. We need to credit it by the entire amount owed, which is the 30. And the reason for that is because if we only credited it by 20, then we would show that G owes us 10 still, and they don't, or they're not going to pay us, so we got to write that off. So therefore, we're going to have a difference, and we're going to need another debit. Where will that debit go? That is going to be the uncollectible portion, which we're going to put into the allowance method. Remember, under the direct write-off method, that debit would go to the bad debt expense. At the time it was uncollectible or determined to be uncollectible, under the allowance method, we already had this 31,000. We already estimated that 10,000 wasn't going to be collectible. We just didn't know who was not going to collect it. We already wrote it off in the prior period to match it to the income that was generated in the prior period, and now we're just going to take it to the allowance. So journal entry would look like this. We have the debit to cash. Cash is going up by the 20,000. We're going to credit the receivable for the entire 30. And then the difference is going to the allowance to debit here. We can see that the 20 plus the 10 equals the 30. The debits equal the credits. Also note that I would put it in this order because this is the order that when I think through the journal entry, that's the order that works best for me to think through it. However, if you're going to post this to something that's going to grade you on having the debits on top, you might want to put the two debits on top. If it helps you to audit or something like that and go back to the information and look at it, then I would record it in whatever way helps you to think through the process. All right, so if we're going to record that in terms of the trial balance, it would look something like this. The cash is going to be debited, so it's going from 100 plus the 20. It's going to go up. We're doing the same thing to it, so we're debiting a debit balance account, increasing it. The receivable is going to go down, so we had the debit here. We are crediting it, doing the opposite to it, bringing the receivable down by the 30, and then that difference is going to go to the allowance. So notice the allowance is a contra account, meaning it's an asset with a credit balance. We're debiting it, doing the opposite thing to it, bringing it down. So then if we think of our questions, do people owe us money? Yeah, people owe us $1,161,000. Who owes us money? Well, if we look at the general ledger, it tells us detail, but it only tells us the activity by date. So we had people owed us $1,200,000. Then we had this $9,000 that it went down by, and then we had the $30,000 that it went down by. Normally that would be from payments. In this case, it went down because we were not paid, and we weren't paid on all of it. We got 20 out of the 30 on this one, but some of them were due to writing it down. We also have the allowance here showing this activity. Here's where the 10 is being posted to the allowance. Here's, of course, where the 30 is being posted to the general ledger. Now, if we want to know who owes us money, we would have to go to the subsidiary ledger. So in this case, note that this $30,000 is being recorded in G's account. So they owed us 30. Now they paid us 10, and we wrote off, they paid us 20, and we wrote off the other 10 because we determined it was not going to be collectible. That's back down to 0. If we add up all customers, then it will add up to $1,161,000. That ties out to the general ledger. That ties out to the trial balance. Of that, we still have this estimate of 21 that will be not collectible. So the reason it went from the prior balance when we started this, which was 40, and now it's going down, is because we now know who's not going to pay us. So this was the estimate, and we didn't know who wasn't going to pay us. Now we've determined that these amounts are uncollectible, and we're writing it off against that 40,000 and then applying it out to the correct customers, which are now determined to be uncollectible. All right, next item, receive payment from CW after we had assumed the bad debt uncollectible had been written off. So in this case, what we're saying is that this is an unusual case, but it's good to look at because it kind of shows us what would happen if someone came in the door and said, here I am, I'm going to pay you now, and we had totally wrote them off in the past because we didn't think that we were going to get paid from them. So in this case, remember that the CW company owed us $9,000. We determined we're not going to get paid that. We wrote off the $9,000 to the allowance account here. So we wrote them off, and now they came in the door and said, I showed up out of nowhere. You haven't been returning our calls and whatnot, but here I am, and I'm going to pay you the $9,000. That's great. So how would we record that? I'm going to tell you the way not to do it first, and then I'm going to tell you why it doesn't work that way. So one way that it kind of works, but it's not the way we're going to do it, is that we can think it through our transactions and say, well, is cash affected? Yeah, we're going to debit cash because we got cash from the client. And we would normally credit a receivable. However, we cannot credit the receivable now because we already wrote the receivable off. Where did we write the receivable off to? We wrote it off to the allowance account. So therefore, since we already we can see this $9,000 was written off to the allowance account, why don't we just debit cash and credit the allowance account, which would cancel out this $9,000 that we wrote off here. That would work, and that works in terms of journal entries. However, it doesn't really work in the system because if we then analyze the receivable account, it looks like this payment was not paid. It looks like the customer is kind of like a deadbeat with it. And so if they came to us again, we don't have an audit trail in their subsidiary ledger showing that they actually paid us. It looks like they never paid us. So what we want to do is record this activity in the subsidiary ledger and have an audit trail on it. Therefore, instead of doing that, we're going to kind of break the rule of thinking about cash first. And in this case, we're going to say, well, let's reverse what we did last time as of today. We're not going to go back in time and do it. We're going to say as of today, we're going to reverse the prior journal entry, putting this customer back in good standings on the subsidiary ledger, and then we'll do the normal transaction, which would be to debit cash and credit receivable. So that would look like this. So we're going to reverse what we did last time, which was to write off the receivable. We're going to put the receivable back on the books by debiting the $9,000 to put the receivable back in good standing here. And then we're going to credit the allowance account. So we've reversed what we did last time. Now we're in our normal circumstance. Now we're back to the norm. And now we can then debit the cash like we normally would when we get money from a client and credit the receivable, reducing the receivable. So it would look like this. The cash is going, the receivable is going to go up by the $9,000, and then the allowance is going to be credited by the $9,000. And then we're going to debit the checking account by the $9,000 and credit the receivable by the $9,000. Note the net difference in the receivable is 0. It went up and down. Therefore, in terms of journal entries, we could simplify the journal entry a lot by just debiting cash and crediting the allowance. You'll note, in essence, that's what we did here. That's what happened. But why don't we do that? Well, let's look what happened on the general ledger. And that is that the receivable went back up here. We debited the receivable here. And then we credited the receivable. So we put it back in good standing. And then we took it off in kind of the normal process. On the allowance account, we can see that we reversed the allowance account here. And then on the subsidiary ledger, what happened for CW is note that we put the $9,000 back on the books as being owed to us, and then we wrote it off here. So the reason for that is if we look here, then the audit trail will basically show us that yeah, we wrote it off, but then we put them back in good standing, and then this 9,000, if we check the audit trail on that from the subsidiary ledger, it'll show a payment. Whereas if we didn't do these two transactions and we just looked at this item and we checked the audit trail, it would show that there was no payment and we wrote it off. So that audit trail is pretty much the reason why we would do this reversing process instead of just having a simple journal entry that would just be half as long. All right, so then we determined that P company and BD company would not pay us the amount owed. So two more companies we've determined maybe at the end of the period, at the end of the year or so, that they're not going to pay us. We're going to probably analyze our receivable accounts periodically and see that companies will not pay us. And if we look at P company here, we're going to write them off. So that 6.7 is going to have to go down, and BD company is going to have to go down. That's the receivable accounts. So those are the amounts it will go down by. Therefore, the receivable is going to have to go down by that. And that's going to be a credit. And then what are we going to debit? Once again, we're going to debit the allowance account. So that would look like this. We're going to debit the allowance account for the 14.7 and credit the receivable. And once again, that adds up to the two clients, P company and BD company, the amounts that they owed. And therefore, we're going to credit the receivable. So the receivable is going to go down, it has a debit balance. We're going to do the opposite thing to it to make it go down. And then we are going to debit the allowance account, making it go down. Note that there's, once again, no change in the net receivable, because the net receivable here was a debit of the receivable of $1,161,000 minus the credit of the allowance. That would be the net receivable. And then they both went down. Therefore, the new net receivable is now $1,146,300 minus the $15,300. So if we look at the activity then, the question's being, do people owe us money? Yeah, people owe us $1,146,300. Well, who owes us the money? The GL just tells us by date what has happened. So what has happened, it went down by 9, it went down by 30, it went back up by 9, it went down by 9, and then we have this 14 went down by that. The allowance shows us the activity for the accounts that were uncollectible. Then the subsidiary ledger breaks it down by customer or client. So here's what happened. There's that 8,000 here, as well as the BD and P, the 6.7. That's what adds up to this 14.7. So we had to break that out between the two customers that don't pay us. If we add up all the receivables, then in the subsidiary ledger, it adds up to $1,146,300. That ties out to the general ledger. That ties out to the trial balance. And we still have this estimate of $15,300 that we determined was uncollectible. So now we're going to say it's at the end of the period. If it's at the end of the period now, and we're done with the year, and we need to then determine what the allowance account should be at the end of the time period. There's a couple ways we can do this. If we think about this, what we're saying here is that the revenue account here of $378,000, if we made all those sales on account, we need to think about the amounts that will be uncollectible. So part of those sales are going to be uncollectible. And what we want to do is write off that uncollectible portion this period. We don't want to close out the books and then write it off next period, because then we'll write off the bad debt expense to the next period. We want to match up the uncollectible accounts to this period. Now, we don't know who's not going to pay us. That's the problem. We know that we made a bunch of sales. We don't know who's not going to pay us. But we can make an estimate of that. And under generally accepted accounting principles, we have to, because if we don't, then we're going to be overstating the revenue or the net income that we have earned in this time period, and we'll be overstating the assets. So we have to make some kind of estimate, and that's controversial because anytime you make an estimate, it's just an estimate, and you can be off on an estimate. It's not exact. But in order to fix the matching problem, in order to present our financial statements in the most fair way and not overstate them, an estimate is better than not having an estimate. So how could we make an estimate? One, we could look at the revenue side here, and we could say, well, if we made all these sales on account, then based on past experience, we could take some percentage of the revenue and say that based on past experience, we have learned that this percentage is uncollectible. Therefore, we can write off the bad debt expense, debiting the expense, increasing the expense for that percentage portion of the revenue. The other way that we can do it, which I'm going to show here, which I think is probably, to me, it's more exact to do, because it seems like you can come up to a better estimate in this way, is to actually look at the balance sheet account, and that would be the receivable account here, and then try to find a way to break down what portion of the receivables are going to be uncollectible. And so that's oftentimes you're going to look at something like an aging account in order to do that. So if we have this 1,146,300, if we break that out, that 1,146,300 in terms of an accounts receivable aging, which could look something like this. A lot of softwares will have this and stuff, like QuickBooks or something can generate this report. And if we have something that's 30 days past due, we could have we might say that 2% is uncollectible. If it's between 30 and 60 past due, 4% perhaps, 60 and 90, 10% perhaps, and over 90, maybe there's a very high chance that it's going to be uncollectible. And this way we can break it down by how old the debt is, which is usually a fairly good indicator. If it's old, if the thing is older and we've been calling people forever and they haven't gotten back to us, then at some point we can say, yeah, there's a higher likelihood or probability that, we're not going to get paid on that one. So where do we come up with these percentages? We would have to get those on past experience. And again, that's something that in a problem the book would have to give you in real life. We would have to do some careful analysis in terms of how we would come up with that. But if we multiply that out, then we're going to say this times this, we would come up with these numbers. And that would say that, okay, of the 1,146,300, we think based on this estimate that 50,437 will be uncollectible. Therefore, we still have 15,300 in the allowance account here. And that's because we basically overestimated last time. We thought that we weren't going to get, I think it was 40 at the beginning. Yeah, it was 40 here last time. And we're still left with 15,300 at the end, meaning that we didn't write off as many. Not many people came and said they were not going to be collectible as we thought. Therefore, in order to get this 15,300 up to the 50, we would do a subtraction problem, and the difference being 35,137 is what we would need in order to bring that amount up to the estimate of 50,000. So if we posted this, so if we took the 50,000 minus the 15,300, we come up with the 35,137. So now if we post this out, then we're crediting the 35,137 to the allowance. So that's going to take the 15,300 up by 35,137 to the 50,347, which matches the 50,347 here. Then the other side is finally going to go to the bad debt expense. So now we're going to debit the bad debt expense by the 35, and that's going to bring it up to 35. And then if we look at what the effect is on net income, we're going to say of this revenue here, 35 of it we believe is going to be uncollectible, meaning we're never going to get paid on that. And we make that estimate kind of like an adjusting entry as of the end of the time period, so that as of the date when we create the financial statements, we're showing a net income of the 342,863 instead of the 378. So we're recording the fact, we're representing the fact that of these sales, we believe this amount is going to be uncollectible. On the balance sheet side, we're also saying, yeah, we have revenue, we have receivables of 1,146,300. However, we believe based on past experience that $50,437 will be uncollectible. We want to disclose that to the readers. We want to be as fair as possible and not be overstating our value. However, it's also just an estimate, and we could collect more, we could collect less. That's our best guess. So we are now able to define the allowance method. Record transactions related to recording bad debt, recording a receivable account that has been determined to be uncollectible, recording a receivable account that has been collected after being determined to be uncollectible. In this presentation, we will take a look at a comparison between the allowance method and the direct write-off method. When considering both the allowance method and direct write-off method, we are considering the accounts receivable account. Remember that the accounts receivable account represents money that is owed to the company, typically from sales made in the past. On account, haven't yet received the funds for sales made in the past, and therefore the company is owed money. We see this amount on the trial balance, in this case $1,191,000. We then want to know information about that, including who owes us that money. We can't find that typically in the GL, as we have a GL for every account. The GL only giving us the information by date. Typically, we want to see that information also broken out in the subsidiary ledger, saying who owes us this money. A problem that we have is that the accounts receivable represents funds we have not yet received and may not receive. If there is some problem with some customers, we might not get the funds. The question then is, should we be writing off this amount at the point in time that we believe we're not going to be able to receive it? Should we be estimating how much we think is not going to be collectible, or waiting until the end of the time period until we determine that something will be uncollectible? The generally accepted accounting principle, the principle that we should typically be using if under GAAP, generally accepted accounting principles, would be an allowance method, meaning that we would be writing off or matching up with the accounts receivable an allowance account that would be an estimate showing us what we think or believe based on past experience will be uncollectible on the balance sheet. And that would write down the accounts receivable and not overstate the accounts receivable. And we would also be writing off the bad debt expense then at the point in time to match it up with the revenue at the same point in time. The other method is going to be the direct write-off method, which typically is not a generally accepted accounting principles method unless the amount of the uncollectible receivables is substantially small and therefore not material to decision making. Otherwise, if we're a smaller company and we're not publicly traded, we may not have to be regulated under the same type of rules and may not be restricted to the method we use, and therefore we need to make a decision. Do we want to use one method or the other? The direct write-off method has the benefit of typically being easier to use because we can just wait. There's no estimate happening. We can wait until we believe something is not going to be collectible and then write it off. Note that does distort the income statement in some ways because we're writing it off at a later time period and therefore not matching it up with the revenue earned in that time period. It also gives us an ability to distort net income in some ways because we can make a decision at the end of the time period to write it off or not. Maybe we wait until the next year or not. Whereas if we use an allowance method, an estimating method, then we have to make some type of reasonable estimate. So those are going to be the pros and cons between the two methods. We'll go through and look at them both. So here's going to be the direct write-off method, where we are going to say that this customer's not going to pay us $9,000. We've determined it at this point in time, and therefore we're going to debit bad debt expense and credit the receivable at this point in time. The difference here being the bad debt expense, which brings down net income at the time when we determine it's uncollectible. If we post this to the general ledger, we're going to say that bad debt is going to go up from 0 up to 9,000 by this debit. That 9,000 then represented here on the trial balance. The accounts receivable is going to go down because they don't owe us any more money or we've given up on it. The receivable is going to be credited. Here's the GL account, $1,200,000 going down by the 9,000 to $1,191,000. That then being represented on the trial balance as well. We can see then on the trial balance that we have the revenue is now going down by the bad debt. The net income then being decreased at the point in time we determine that the bad debt would be uncollectible. We also want to see the information that would back up the accounts receivable. That would be on the accounts receivable subsidiary ledger. Here's the CW company owing us $9,000. We're writing that off, bringing the balance down to zero after that point in time after we write this off. So now it's down to zero. That would be owed to us there. And remember that the subsidiary ledger would include all people that owe us money, all companies and people that owe us money. And if we added them up, it would tie out to what is on the trial balance as well as what is on the general ledger. If we contrast that to the allowance method, we have the similar journal entry decreasing the receivable here, but the other side not go into bad debt, but instead go into the allowance account. So now we have the same accounts receivable result. It's starting at $1,200,000 going down by $9,000 to $1,191,000. However, now we're using this allowance account, which we weren't using before. We just had it as a demonstration. And we had already estimated that there's $40,000 that was made in the prior period, the prior year, or the prior month, that we wrote off in the prior period to match it up to the revenue in that period. And we created this allowance account. And now we're just going to write down that allowance account. No effect down here to bad debt at this point in time. No effect to net income at this point in time. We, at the end of the period, will make an estimate based on the revenue and or the accounts receivable to determine how much of this revenue we think is going to be uncollectible and therefore be matching up with the matching principal. So in this case, when we write it off, there's no effect on the net income accounts. It's just affecting this allowance account, which we had set up prior. And we still have the decrease from the $9,000 down by the $9,020 in the accounts receivable. Same activity in the trial balance, the general ledger in terms of accounts receivable, back to that $1,191,000, $1,191,000. If we take a look at a side-by-side comparison, here's the bad debt, the direct write-off, and here's the allowance method. So here we're not using the allowance account under the direct write-off method. It's just there to show what account would be used under the allowance method. It's not being used under this side, the direct write-off. It is being used over here. We can see that we have the $1,191,000, nothing in the allowance. It's not a relevant account under the direct write-off method. Over here, we still have the $1,191,000, but we have this $31,000, which was there prior. It was created prior to this time period when we wrote off the bad debt related to the prior time period. So this 31 is still left over that we think could be uncollectible or become uncollectible at some point in the future based on an estimate. On the income statement side, we decreased net income by that $9,000. So the $378,000 minus this $9,000 is the $369,000. On the allowance method, no write-off to bad debt at this point in time. We won't write it off until we make an estimate at the end of the time period based on either revenue or our accounts receivable. Next transaction, G Company payment $20,000 of $30,000. This is going to be the direct write-off, half of this, so we're looking at the direct write-off. We're going to say that we did get cash, so we debit the cash, it's increasing. Then the accounts receivable is going off the books for the $30,000, the entire amount owed. We're not going to get the added $10,000. The difference then is going to be the $10,000. We have to put it somewhere. This will be the difference between the two methods. Under the direct write-off method, we'll write it off to the bad debt expense. Under the allowance method, as we will see in the next slide, it would be going to the allowance for doubtful accounts. If we record this, then cash is going to go up $100,000 plus the $20,000 to $120,000. We can see the accounts receivable is going to go down. We were at $1,191,000, down by the $30,000 to $1,161,000. This matching up with what's on the trial balance now, the $1,161,000 and the $120,000. And then we have the bad debt, which is going to go from the $9,000 up by $10,000 to $19,000. That, of course, over here on the trial balance as well. Note that we are increasing bad debt expense at this point in time, that being the difference, that then affecting net income going down. We also want to remember that we will be recording something to the subsidiary ledger. This company, this particular company, owes us $30,000. We're going to decrease it down by $30,000 to 0, meaning they're not going to owe us anything anymore. Even though they only paid us 20, we're not going to leave the 10 there that they still owe us. We gave up on it, and therefore are going to write the entire thing out down to 0. Contrasting that with the allowance method, we still got the cash, we still got the receivables going down to 0, but instead of the 10,000 going to bad debt, now it goes to the allowance for doubtful accounts. So we have the same effect on the accounts receivable, 1,191,000 down by the 30,000 to 1,161,000. Same effect on the allowance same effect on the subsidiary ledger, the company going down to 0 in terms of the subsidiary ledger, 30,000 minus the 30,000 to 0. The difference being that there's no impact on the income statement, bad debt not being affected, no effect on net income. What is happening is we have this allowance account, which was at 31 prior to this, now going down by that 30,000 to the 21. Remember that this 31 was there prior to this time period. It was there created from the prior time period based on an estimate, and we created the bad debt expense based on either the revenue or the accounts receivable, and then we closed it out. Of course, that's why there's nothing in bad debt expense, because it got closed out at the end of the year or the end of the month, and therefore is at 0, and we're writing off the uncollectible receivables here that has already hit the income statement in our estimate. We estimated it prior to this, wrote it off in the prior time period. It then rolled into the capital account in the closing process, and therefore is not on the income statement for this time period, and we're just writing off the bad debt to the allowance account. We will have a bad debt, won't happen, however, until we make an estimate at the end of the time period. If we compare and contrast the two, then this is the bad debt, this is the allowance method. This is the direct write-off method. This is the allowance method. We have no allowance for doubtful accounts. It's just there for demonstration. We're not using it under the direct write-off method. We have 19,000 of people that we have determined will not be collectible, and therefore wrote them off, decreasing net income by that 19, the 378 minus the 19, bringing net income to net income of 359,000. We have the same receivable over here, but then we have the allowance account. It's now going down to 21,000 because that's where we wrote off the people that we have determined that would be uncollectible. No effect on bad debt expense, no effect on the income statement from writing off these accounts thus far. Next one, we're going to say receive payment from CW after writing it off. So this is that unusual one. It doesn't happen all that often in real life. We're going to first take a look at the direct write-off method. This is a really good example problem though, because it allows us to see the difference between the two methods and what would happen if we had to reverse a write-off. And so it makes us think kind of backwards, which is great for testing and our knowledge on this type of stuff. So we wrote CW off. We said, hey, they're not going to pay us the $9,000. And then they came in even without our collection actions. We gave up collecting the money. They came in and paid us, and that's great. So you would think that we would debit cash and credit some other account. We couldn't credit accounts receivable because we already wrote it off. We wrote it off, in this case, under the direct write-off method to bad debt. So you would think we can just debit cash and credit bad debt. But if we did so, we wouldn't have it run through the receivable account. And if we looked at the receivable subsidiary ledger, it looks like this $9,000 is due to them not paying us, and we want to show that they did pay us. And therefore, under either method, we do need to reverse what we did prior to give us a paper trail that this client is good. So therefore, we're going to reverse what we did last time. Under the direct write-off method, we credited accounts receivable and we debited bad debt. We're going to reverse that. Going to put them back on the books, increasing the accounts receivable by the $9,000. Decreasing bad debt. Unusual account here. Bad debt and expense typically only going up with debits. This is an exception to the rule. We are reversing it under the direct write-off method. This being the difference between the allowance and direct write-off. Under the allowance method, this would be the allowance for doubtful accounts account. Once we do that, then we can just do our normal transaction that would happen if a company came in and paid us on account. Debiting the checking account, increasing the checking account, crediting accounts receivable, decreasing accounts receivable. Note between these two journal entries, here's accounts receivable, here's accounts receivable, debit, credit, doing the same thing. If we eliminate those two, we're left with a debit to the checking account, credit to bad debt. So we could shorten this from just a technical standpoint to just this with one journal entry, but that doesn't give us a good paper trail, therefore we don't do that. So if we post this, then we're going to say accounts receivable is going to go back up by the 9,000 to this, and then we're going to say that the bad debt is going to go down. Here's the 9,000 here. We're now eliminating it, and that brings us to the 10,000 down from 19. And then we have the cash account, which is going to go from 120 up by the 9,000 to 129,000. And then we're going to have the second component, which is going to be this item here, the accounts receivable going down, bringing the 1,170,000 down by 9,000 to 1,161,000. That's where we're at now on the accounts receivable on the trial balance. And then we got the subsidiary account, and that's went from 0. It's going to go up by 9,000 to 9,000, and then we're taking it back down again, down by 9,000 to 0. So the accounts receivable subsidiary account went from 9,000 credit back to 0. Then we debited it by this 9,000 here, bringing it back up to 9,000, and then we credited it by 9,000. This looks really repetitive because this is where we started, and then it went up, and then it went back down. But this gives us a paper trail. This item, if we were to drill down on it, would show that we got paid here. Whereas this item, if we drill down on it, would show that we gave up on the customer. So that's the important difference between reversing this rather than just recording a debit to cash, credit to bad debt expense. If we look at the allowance method, same type of activity. We're going to reverse what we did, and then we're going to record the normal transaction. The only difference here being this item. When we first recorded the write-off, we debited the allowance for doubtful accounts and credited the receivable. Now we're just reversing that. So we debit accounts receivable just as we did under the direct write-off, but instead of crediting the bad debt, now crediting the allowance, just reversing it. Then we're back in good standing, and we can do the same thing that we did in the direct write-off method, or the same thing we would always do when we receive cash on account, debiting cash and increasing cash and decreasing with a credit accounts receivable. So note here, no effect on the net income. The allowance account then is going to go back up from 21 up by the 9 to the 30,000, and that's because, of course, this individual did pay us, so we're not taking that down. The accounts receivable account on the general ledger went back up and then went back down. So we can see it just went up, down, same thing. We put it back in and took it back out. If we look at the CW account here, this is where we started. Same thing, his subsidiary ledger account for this customer goes back up by 9 and back down. Everything is the same except for this allowance account being the reversing account we're using, not affecting the bad debt expense. And the way to think of this is just to think about what did we do before and reverse it. If we look at the comparison, here's the direct write-off, here's the allowance method. Direct write-off, I'm showing the allowance account here, but it's not used. It's not being used here. That's why it's red. It's just a placeholder. And what we did was change the bad debt expense to write off or reverse what happened, and then record our normal increase in the checking account and receivables. Under the allowance method, we have the same thing except no effect on bad debt. The adjustment that happened here in the allowance method, increasing that allowance back up. We will have the bad debt at the end of the time period when we make an adjustment under the allowance method. These will be the major differences when recording the normal transactions for an individual or customer that is determined to be uncollectible, and when they pay us after we wrote them off. Going forward, the allowance method will then have an adjustment in order to record the allowance for doubtful account based on either the revenue method here in terms of how much revenue was earned, taking a percentage of that to determine what the bad debt would be matched up against that revenue. or use a balance sheet method, taking a look at the accounts receivable and determining how much of the receivable is going to be uncollectible. Either way, it's better in terms of the matching method. So the next step on the allowance method would be to determine in some way what the bad debt expense is, not by knowing or finding out who is not going to pay us this time period from sales made in the past, but instead making some type of estimate in terms of this revenue made this time period, how much of it will not be paid, thereby matching up the expense to the related income in the same time period. That estimate, once again, could be made either by looking at revenue, taking some kind of percentage or some type of estimate based on the revenue earned this time period, this month, this year, or look at the balance sheet account and seeing how much of this we believe is going to be uncollectible. That then getting to the same number of bad debt, but doing it in kind of a reversed type of way. Whatever we decide is uncollectible, whatever we have to adjust this allowance account to be, the difference will be the bad debt expense here that will be matching up revenue and expenses. In this presentation, we will be taking a look at the allowance method for accounts receivable, focusing in on the calculation of the allowance for doubtful accounts. There are two methods that can be used in order to calculate the allowance for doubtful accounts, one being the percentage of accounts receivable, the other is the percentage of sales. We will take a look at them both and look at the pros and cons of them. First, we're going to look at the accounts receivable method. We're going to start off with the percentage of accounts receivable method for a few different reasons. One, it's the one that's most often tested, and two, it's the one that may be most often used in practice, often making the most sense to people that are looking at the two methods. It's also a bit more complicated, so when we're looking at test questions, they typically would focus on this method in order to have a bit more complicated process to do the calculation. It's important to note, however, that there is another method, and that's going to be the revenue method or the percentage of sales method. If we want to be able to compare and contrast those two, we can ask a lot of theory type questions in terms of what are the pros and cons between the two methods, and there are pros and cons between the two methods. Remember that the overall goal here is to say this is our accounts receivable account. We are recognizing that there's going to be a significant amount of these receivables that will not be collectible, and therefore we need to tell our reader that. We need to tell our reader that for two different reasons, one being a timing issue, which is going to be on the income statement, and the other being a balance sheet issue, a point-in-time issue, which is the balance sheet. On the balance sheet side, which is where the accounts receivable method will be focused, we have this receivable, this asset on the books showing that people owe us this amount of money. And we're telling people, the reader of our financial statements, hey, look, we're going to get this much money and therefore, make decisions based on the money we're going to receive on these financial statements. However, we know that we're not going to get some of it. So it's our responsibility then to show our reader, hey, look, based on past experience, we believe that this amount is not going to be collectible. So that's going to be one objective of the method here. Either method is to show the allowance for doubtful accounts, which will match up against the accounts receivable being a debit here, the allowance being a credit. The difference between the two, the net receivable, the amount that we actually believe that we will collect based on prior experience. That number then should be more accurate in terms of what our true assets are in the company. As we do this, we'll also be looking at the income statement side and writing off the bad debt related to the revenue. And this is the part that's a bit more confusing when using the accounts receivable method, us then focusing in on the balance sheet, focusing in here on what we think is uncollectible. The byproduct of that tends to be what the bad debt will be. But they're both important because the bad debt is going to be an expense related to revenue happened in the same time period that will be decreasing the net income for the amount of this revenue during this month, this year, that we think is going to be uncollectible based on past history. This concept, the income statement concept, makes more sense when we look at the revenue method, which we'll take a look at later. That method then focusing here on the bad debt and matching principle of the current time period, whereas the allowance method tends to focus more on the balance sheet where we are at certain point in time, how much of the current receivables are uncollectible. Under the balance sheet method, there's a couple different ways we can do this, but what we need to do is just say, how much of these receivables are not going to be collectible? One common way to do that is to look at something like an aging account and try to list out these receivables in terms of how old they are, and then go through past experience and say, the older accounts, of course, are less likely to be collectible, and try to figure out some type of percentages that would be reasonable, that would be uncollectible based on past experience. So if we say that here's our total here, here's our total, and we're going to break that out between 30 and 60, 60 and 90, and over 90 days, that something is either current or still due within 30, and then 30 and 60 past due, and 60 and 90, some type of breakout in terms of time frame that we believe these accounts are past due by, and thereby not judging people based on who the customer is, but just by how old the accounts are as to whether they'll be collectible or not. Notice we don't have any names here. We're just recording them in terms of how old they are. So if we take this and we say, okay, if we go through all these accounts and we were able to break this out, and of course software can do this very easily for us, give us an aging account. We're going to say that 30, they're with either current or past due for 30 days. We're going to say this is current, I guess. And then we're going to say between 30 and 60, this is how much of this amount, this 1,146,300, belongs here. 60 to 90, we're saying is this amount of here of the accounts receivable falls into the 60 and 90 range. And then over 90 days past due, we're going to say it's the 22,926. Point being is that we broke this out. If we add up the 917.40, the 171,945, and the 34,389, and the 22,926, we get to the total 1,146,300 broken out in terms of how old this debt is. Then we're going to come up with some type of reasonable estimate based on how old the debt is to calculate how much will be uncollectible. So if this is current or if this is 30 days past due, we're going to say that 2% of it we think is going to be uncollectible. If it's current, then we're saying not very much of it will be uncollectible. We're hopeful that we're going to collect most of it. So we're going to say that of that, the 917.40 times 2% is 18,341. Between the 60 and 90, how old the aging is, we're going to say, well, these are a bit older, and therefore we're going to say that 4% is not collectible because we haven't been able to collect it yet. We're past the collecting date, due date, and therefore we're going to say that 6,878 is going to be not collectible. And again, you could ask, well, where do we get this 2% and this 4%? It's an estimate. We have to come up with some reasonable estimate based on past experience and or industry standards. And then we're going to say of the 34,389, 10% is uncollectible based on past experience and industry standards. So this times that equals the 3,439. And over 90, we're going to say is very unlikely we're going to collect it. And so if we take the 22,926 times the 95, we get the 21,780. Now you might be saying, where did you can question these percentages or whatnot, but they would be based on industry standards, past experience. They should be reasonable in accordance with the industry based on past research. If we then add these up, 18,341, the 6,878, the 3,439, and the 21,780, we get to the 50,437. This number then is what we believe of this number, receivables, people owing us money, will not be collectible. We don't know who, no names here. We just know that we believe that that much will be uncollectible. It's a complete estimate, and this is kind of disturbing to some people. They say, well, it's just an estimate, and we don't really know. There's no certainty. However, it's more reasonable to do this. This is obviously a very significant number on the receivables. We need to tell our reader that people owe us money because that's important to decision making. And we can't wait until people don't pay us. That would be unfair to readers of the financial statements because we wouldn't be matching it up at the proper time period. We'd be overstating the receivable. So although this is an estimate, it's much more fair representation as long as the estimate is fair than either not recording receivables or not recording how much we believe is going to be uncollectible. So we have to come up with some type of reasonable estimate in order to make them as fair as possible. Now note that under this method, there's already something there in the allowance account. So we can't just use this number to make our journal entry. We have to determine what we need to do in order to make this account that number. We want to make this number that number. So we can't just use what we came up to here. That's a common error on test questions, to use this number in the journal entry. We have to do a subtraction problem. Why is there something here already? Because it was just an estimate from last time period, and it's never going to be exact. It's just an estimate. So we're just updating what this allowance account should be based on our best guess. We think it should be that. Therefore, the adjusting entry, if we take out the trusty calculator, it's going to be the 50,437 minus the 15,300. That's how much it needs to be increased by. Now, it's possible for this account before we start to actually have a debit balance. And why would that happen? That would mean that in the prior time period, we estimated that we had so much that would be uncollectible, and more happened to be uncollectible than we had estimated, flipping this account to a debit balance. That doesn't happen too often, but if it does, and we need to get to this 50,000 and this was a debit, then we would have to credit it by something to get it back to zero, and then add another 50,000 to it in the credit direction. In other words, if this, say, was a debit balance of 15,300, we'd have to take the 15,300 plus the 50,437 to get it to the credit balance of 50,437. If this is a credit balance, then that means that we had less people that would actually be uncollectible in the prior time period than we had estimated, probably the normal case, that being the normal case, and therefore we have to do a subtraction problem in order to get this up to 50,000. We need to increase this in the credit direction. So if we record the journal entry, then we're going to record the bad debt expense, a debit here, and we're going to record the credit of that 35,378 here. If we see that recorded out, then we see that the 35,378, and that amount is going to be on the allowance account, bringing the 15,300 up by the 35,178 to 50,437. That then on the trial balance, on the bad debt, we bring the balance up. It started at 0 here. It should have started at 0. Up by the 35,137 to the 35,137, that amount here. Now note what's happening here is we are recording on the revenue side the expense, bringing down net income. So this is the point in time that we bring down net income, and this 35,137 should be matching up to this revenue account. It's less intuitive here to know that that's the case, but by us making the accounts receivable correct in terms of the allowance account, then the other side of it should be matching up the revenue and bad debt. This will be more apparent when we focus on this side and focus less on the balance sheet and the sales method. On the balance sheet side under the allowance method, it seems very straightforward and very useful, the balance sheet being as correct as possible by us looking at the receivable, analyzing the receivable in a logical way, determining how much of the receivables that are due to us will not be collectible, 50,437, and then showing that on the financial statement so the reader could say, okay, this is how much is owed to the company. This is how much they believe is not going to be collectible based on a reasonable estimate of this number. And therefore, the net of those two is how much we are going to collect. This makes good sense under the receivable method. This side is more confusing under the receivable method because we're not focusing here. So now we'll look at the other method, which is going to be the percentage of sales method. And we're just going to focus then on the receivable side. Again, not shown as often because, one, it's an easier method, so therefore textbooks don't focus on it. Two, a lot of people probably intuitively look more on the balance sheet here and have the income statement kind of fall out. They kind of say, if I make the balance sheet right, if I make the receivable and the allowance method right, then the income statement will fall out and it'll make itself work, and whatever problems will happen will then roll out into the equity section after we close out the temporary accounts, and we'll be good going forward. So probably most people focus more on making the balance sheet correct. But this is going to be a valid method too, the sales method, and it focuses more on the income statement, showing the income statement, analyzing the income statement accounts, and making sure the bad debt is right, and letting the allowance side fall out and just be correct. Now, one way to do it, a simple way to do it, would typically just be, let's take a look at the revenue and take a look at a percentage of the revenue based on past experience that we believe is not going to be collectible. Now, a lot of textbooks will basically say, in practice, say we need to look at the revenue on account. We need to look at those sales that we made, not for cash sales, but sales on account. Or the text might just say that we make all sales on account, and therefore we can take the entire revenue amount. So that's going to be a slight difference that you might see based on different textbooks or different situations in real life. How would you want to do it in real life? You probably want to look at those sales that are on account and then try to look at past history and see of the ones that were made on account, meaning we didn't collect sale revenue at the time of the sale. We collected it, we're going to collect it at some other point, therefore it's in receivables. So how much of those sales that we make on account where we don't collect cash at the point of sale do we think are uncollectible based on past history? And then if we say that it's 3%, we're going to just take that number, the 378,000 times 3%, 0.03. 3%, 0.03 gives us the 11,340. And that's it. That's a straightforward calculation. And we're going to say that the bad debt then should be that number. So the bad debt is going to be the 11,340. And then the other side just falls out. We're not focusing on this side here, the allowance. We're just going to make it whatever it needs to be in order to make what we think our bad debt should be in order to have a correct matching principle for this time period. So note here that we're focused on this number and we're really making net income as accurate as possible by focusing on this current revenue. Whereas when we focus on the accounts receivable, we're really focusing on everything that's happened up to this point in time, where we stand at this point in time. And therefore, when we use the accounts receivable method, we're kind of fixing possible errors that might have happened in the past and re-looking at everything that's happened in the past to make receivables correct, and this number then falling out. On the income statement side, we're focusing on this time period only, and the side that falls out then will be the balance sheet side. So this will give us more focus, and it's easier to see in this method that we are indeed following the matching principle. We are trying to look at this current revenue and see how much of that current revenue is not going to be collectible based on some type of reasonable estimate, and therefore write off the bad debt, not bad debt for sales made prior period, prior month, prior year, but the sales that were made this year. That's going to be the point, and therefore net income for this time period we would think is as accurate as possible. Note, however, it still achieves the goal of making the allowance account what we think it should be. It just falls out differently. If we did this correctly throughout the entire period, then the allowance account should fall out correctly and be correct as well, meaning the accounts receivable, what is owed to us, minus an estimate, what we think is uncollectible, should still give us a reasonable estimate of what the net receivables should be. If we look at a comparison between the percentage of accounts receivable and the percentage of sales method, note that they're almost never going to be the same. So we didn't make an example where they happen to come out the same here because it just doesn't happen typically. So, and here we have a different type of allowance account under the two methods. And it could be more, it could be less, just depending on what time period we are using. So in other words, the allowance account here could be higher or lower under the accounts receivable method versus the sales method. Point being, it'll typically be different. And the bad debt, same thing. It'll typically be different under the two methods. It could be higher, it could be lower, depending on what our focus is under the two methods. So notice they are estimates. These are both going to be estimates. They're not going to be perfect, and but they are better than not estimating. They're better than waiting until this is going to be uncollectible, and they're far better than not showing the accounts receivable at all, because the readers obviously want to know what the accounts receivable is, how much is owed, and they want some type of estimate of what is not going to be collectible. Also note that once we have a method here, because we are using some type of estimating method, we want to be consistent with that method so that we have comparison from time period to time period. So if we're using a percentage of accounts receivable, we typically want to use that next time period, next month, next year as well. If we're using a sales method, we typically want to be consistent. Our goal here is to have consistency, is to have a matching principle that we can compare time period to time period going forward. In this presentation, we will take a look at notes receivable. We're first going to consider the components of the notes receivable, and then we'll take a look at the calculation of maturity and some interest calculations. When we look at the notes receivable, it's important to remember that there are two components, two people, two parties at least, to the note. That seems obvious, and in practice, it's pretty clear who the two people are and what the note is and what the two people involved in the note are doing. However, when we're writing the note, or just looking at the note as a third party that's considering the note that has been documented, or if we're taking a look at a book problem, it's a little bit more confusing to know which of the two parties are we talking about, who's making the note, who is going to be paid at the end of the note time period. We're considering a note receivable here, meaning we're considering ourselves to be the business who is going to be receiving money at the end of the time period, meaning the customer is making a promise. The customer is, in essence, we're thinking of making a note in order to generate that promise that will then be a promise to pay us in the future. So in essence, you can think of a note as a type of promise. We are the business in this case. We're providing a service, and therefore the customer is making a promise in order to pay us at some point in the future. We're asking for a bit more commitment of the promise than we would typically have under an accounts receivable situation, and typically the reasons for that would be that the amount of the sale was greater possibly, so it's a bigger dollar amount that we want a formal documented promise to pay us, and or we're going to charge interest on the loan that we're making here. Now remember that although we're thinking of it as a promise from the customer, it's probably the case that we as the business who deal with these type of documentations and promises all the time are probably the one that are going to generate and print out the formal type of documentation as part of our business that the customer can then sign as the promise to pay in the future. But from a conceptual standpoint, we can think of it as the customer basically documenting or making this, filling out this promise in order to pay us in the future. Couple critical components that will typically be in any note receivable, even a fairly simple note receivable, which we will typically have documentation for and have a formal written document when it's a larger dollar amount and we're charging interest. There's a larger or longer time frame involved than the normal 30 days or 60 days possibly of an accounts receivable. So we're typically going to have the amount. We're going to have the amount of the note. That would be if we sold something as the business, then we maybe had a sticker price of whatever we sold of $1,000, and therefore are owed $1,000. There's going to be a promise by the customer to pay us for what they purchased. Then we're going to have the date of the note, typically the date that the transaction happened, the purchase happened. Then we're going to have the due date, and oftentimes the due date is going to be written something like this: 90 days after date of note, I promise to pay to the order of, and then we'll have the name of the payee. And that's for a couple different reasons. Note that this doesn't just have a date at some point in the future. Typically, a lot of times the note will be written in wording such as this. And part of that could be that it makes it easier for us, if we're the business who are generating this note for the customer to sell, and we do this often, then it could be a pretty standard way for us to just say 90 days from any point of the date of the note. And that makes it easy for us to make like a template to make the note. But in any case, the terminology will often be like 90 days, 30 days, 120 days for the note. We're going to be dealing with notes here typically shorter terms, meaning less than a year when we're considering the notes that we'll be working with. Now, it's important to keep straight that the payee, as you can see from the wording of the note, is who we are promising to pay. So that's in essence us. That's the business. That's who we're going to get paid at the end of the time period, the principal amount plus the interest. So the other component then will be the interest. We're going to pay $1,000 for value received with interest at the annual rate of 10%. So that's how much is going to be paid. Note how much is going to be paid then in terms of two components. One, the principal component. This is kind of like the loan that we gave. We didn't give them a loan in dollars. We didn't loan out the dollar amount, but we sold something with a sticker price of $1,000, didn't get paid yet at the point of sale, and therefore are in essence loaning this money, renting the money out to the customer, and we're going to get paid that money at the end of the loan term, 90 days, typically greater than a normal accounts receivable term, and we're going to get paid interest on top of the loan. Note what's not being said here is we don't have an official end date. We have 90 days from the due date, so we'll have to figure out when that will be. When is this actually due? And we don't have the actual amount that we're going to get. We know we're going to get $1,000. That's the sticker price. And then we got to figure out the 10%. This is typical in many notes. So if you read a note, oftentimes it's not going to give you like an amortization schedule or an interest type of calculation. Not required to have that in the note because you can figure it out. And so oftentimes it's not included. But you're probably going to want to figure that out, and we'll take a look at that, and we'll need to know that in order to make the payment at the end of the time period. And then we've got the maker of the note, and remember that is going to be, in our case, the customer. We're imagining the customer is the one that's making this promise. So that's the thing that's often confusing when we think about these notes. Who's who? It seems obvious, but it can be a little bit confusing in terms of who's the payee and who's the maker. Although we as a customer, when we go and finance something, don't think of ourselves as writing out this little promise, but you can think of it as making this promise, as if we're writing this out. We're saying, hey, give me a piece of paper. I don't have the time right now. I don't have the money right now, but my word is good. Give me a piece of paper and I'll write out you a little promise, a little formal promise here, right? Here's the date. Here's the amount. I promise to pay it within 90 days. And I promise to pay you not only the principal, but 10% interest for giving me the service of loaning me this money for a certain time period. And then the person making the promise, the customer in this case, the maker, signs the note. Of course, in practice, the person who has this document made, formally made, would probably be the business, them being the person who is used to making this documentation, then allowing the customer to read it and go through it and sign it as well. So if we look at the components, remember that the principal is up here. We're going to break out these two components of the payment of the note at the end of the time period in two components. One, the principal, the amount of the original loan. Two, the interest. Then we're going to have the due date, which is here, 90 days from the date of the note, which we'll have to figure out, well, when will that actually be? Then we've got the payee, who's going to be paid at the end of the time period. It's going to be paid the $1,000 plus the interest, who's going to get that payment at the end. We have the interest rate, in this case being 10%, and the maker of the note, the person who signed the note, the person who made the promise for the note. Okay, so then we're going to figure out the maturity date. This can be a little bit more confusing than you would think, because if we're saying it's a 90-day note, and that we're saying the due date was 1/15, well, we really got to think, well, now, I mean, each month has a different number of days in it, so it's actually little bit confusing to go through and figure out when the actual date of maturity is. And this is actually a common problem. Of course, the computer can help us out when we generate this, and they'll typically give us the due date because it could be computer generated. But note that when you're working problems and when you're figuring this stuff out and when you're trying to just say, what's 90 days from this due date, it's a little bit more confusing than you might think. And you want to have a system, if you're doing a test question, to be able to figure that out. And if you're in a system where you're figuring this out all the time, have some computerized system, or just note that it might be a little bit more confusing than you would think at first. So we can think about that by saying that, okay, we're going to count up 90 days. There's about 30 days in each month, but it's starting on January 15th. So we can start off with a kind of a little subtraction problem. We can say, well, there's 31 days in January, and we know that the note date is as of the 15th, so 31 minus 15 means there's 16 days left. Now be careful, because it depends on whether or not we're going to be counting the day of the note term, like this 15th day. So the question is, does that count in the term of the note? And you're going to have to be kind of careful on that. So if you're off by basically a day of a problem, of a computer problem or something like that, or a multiple choice problem, that may consider the fact that, well, is this 15 day included or not? If it is, then we'd have to add to that one more for this day, for the 15th. We're taking the difference between the two, 31 minus the 15, which would start at the 16th. You can count it out on your fingers, right? 16, 17, 18, up to 31, 16 days. And then we can count up from there. We're doing around 3 months because it's 90 days. So we're going to say the days in February, we're going to say it's 28 in this year. And then we're going to say the days in March are 31. And then we're going to consider, well, we need to be at 90 days. So we can just figure out where are we going to lie then at the end of this. We're going to say, well, 16 days that are left in January plus 28 days plus 31 days, that gives us 75. We need to get up to 90. That's not going to complete a full another month. So how many days then are we going to need in April? It's going to be 75 minus the 90, or 15 more days. So this last piece, we're going to say days in April, or the due date is going to be April 15th. So in other words, if we calculate this one more time, we're going to say we have 16 days in January, plus 28 days in February, plus 31 days in March, plus the 15 days in April, and that gives us our 90 days. So that means the due date is going to be here on April 15th. So just be aware that due date calculation can be a little bit tricky. Okay, so when we record the note, it's a pretty easy thing to do, to record the note, but often very confusing for people when you see this note. You see this note and you say, oh man, there's a principal amount, there's an interest rate of 15%, there's the 90 days of the due date. And so you would think that when I record the note, it's going to be fairly confusing. But really, when we record the note, all we need is this 1,000. And so it's deceptively easy to record the note. The interest of the note and the due date doesn't come into play until time passes. We haven't earned any interest as of the day of the note. If we sold something for $1,000 and they gave us a note saying they will pay us in the future, then all we have to do is record the note at this time period. Interest accumulates as we basically rent them money. It's rent on the money. So we have no rent on the money when we just gave the note. So to record the note, if we sold something for $1,000, we would just record the sale of $1,000, and then we debit, instead of accounts receivable, notes receivable. So note, it doesn't matter. All this other stuff, like, I don't need any of this stuff. All I need to know is that there's a note for $1,000. I don't need to know the interest rate. I don't need to know the terms. I don't need to know any of that in order to record the note. So just be aware of that. It can be really confusing because of too much information to put the note on the books. Now, of course, if we made a sale and we sold inventory, we would have the other side of that, cost of goods sold, and the inventory going down. But so this is the same transaction. This should look familiar for us making a sale on account. Instead of having accounts receivable, we're now having notes receivable, typically because the amount of the note is a larger dollar amount. We want to charge interest on the note, typically the term of the note being longer term, and therefore having a formal written document. We then will be tracking it not in the subsidiary ledger for accounts receivable, but in a separate note receivable, and tracking both the principal and the interest. So same transaction, just replacing accounts receivable with notes receivable, and pretty straightforward transaction. Then when we're going to calculate the interest, we're going to have to figure this out so that we know how much is going to be paid to us or due to us at the end of the time period. So note, at the beginning of the time period, there's only $1,000 due us. And that's it. There is no interest yet. There's no interest until time passes. After time passes, then they're going to owe us the interest because we rented them money, and they have to pay us rent on the money. They have to pay us interest on the money. So how much are they going to have to pay us because of the rent on the money? We'll figure that out now. We got $1,000. The interest rate is 10%. So 1,000 times 10%. And remember, if it's in a calculator, we're going to say 1,000 times 0.1, or 10%, 0.1. If you move the decimal over 2 places, it's 10%. That's $100. So that gives us the $100. And then I typically think about it this way. Remember that this interest, and we'll go over this in more depth later. We'll figure out different ways to calculate the interest. But interest is for a year. So it says it here, an annual rate. Even if it doesn't say annually, whenever we think about interest, we think about it in terms of a year. So we have to understand that whenever we talk about interest, we talk about in terms of a year, even though the note term is rarely for 1 year. It's often for a series of months. And we'll have to then break out this interest amount, which would be for a year, if the note was out for a year, into some monthly amount. So in order to do that, one way to do that is we can take the days in a year are 360, and we can take that $100 divided by 360 days. Or, it doesn't come out even, and we'll have to deal with this, 0.2777, right? And so that's going to be the amount. Now, where did we get the 360? There's 365 days in a year, typically. We're going to use a rounding a number to make this an easy calculation for simple interest. Meaning, we're just going to take 12 months times an average of 30 days in each month, or 360 days. And that'll give us a nice even way to calculate this simple interest that we'll be calculating. So once again, we have $100 divided by 360 days in a year. That's about 28 cents per day if we round it, so 28 cents. We need to be careful about this rounding. We cannot get away from rounding. It's always going to be a situation. So we could make problems that come out perfect all the time and they don't round, and they round out perfectly, but in real life, there's going to be this issue. So if you're off by a little bit, a couple dollars, it could be a rounding issue, and we always have to be aware of that. So then if we have the 28 cents per day, and the number of days of the note is 90 days, then we can multiply that out, and we get the 25 here. Again, if you do the math here, and you say 0.28 times 90, it's actually 25.2, and so that's a rounding issue there. And remember, this wasn't actually 28. It's 100 divided by 360 is actually 2.777 times 90 is 25. So if we use Excel, and we'll take a look at Excel, we'll be able to know how to deal with these rounding issues and make it exact. So just note that those are always going to be something that we have to deal with. Things aren't going to be perfect in terms of dollars and pennies. We need to figure out how are we going to deal with these rounding issues. And when we're off by $1 or so, we need to recognize that and say it's okay, well, it's rounding. We'll figure it out. Okay, so then if we're going to say that the interest is $25 that will be earned at the end, then when we get paid at the end of the time period, we're going to get paid, then what's our journal entry going to be? Well, cash is going to be received, and the note receivable is going to come off the books. Now, we'll see this with an example problem with a trial balance. It's a lot easier to see if you have a trial balance. But the note receivable we put on the books, remember, by a debit of 1,000. It's kind of like accounts receivable. It has a debit balance. We need to now take it off the books because we're going to get paid. We're going to get paid more than 1,000 plus the 25, but we're going to take it off the books for the amount that's on the books, 1,000. That 25 is going to be interest revenue. So it's going to be revenue that we earned. We earned revenue based on not the sale when we earned the $1,000 when we sold it. This is revenue that we earned for renting money, in essence. And it's going to increase revenue, increasing an income statement account, a revenue income statement account, which will increase net income. And then the cash we get will be the 1,025. So remember, we made the note for 1,000. When we put it on the books, we only put it on for 1,000. Then we had to take it off the books, taking that $1,000 off. But at this point in time, we had earned $25 throughout the term of the note, and therefore we're recording more revenue than we had recorded at the beginning of the note, because we recorded revenue for whatever we sold at the beginning. Now we're recording revenue due to the fact that we loaned out money. We made interest on the money. We rented money. That's how we earned this 25, increasing net income by the 25. And then we got then 1,000 principal back plus 25 interest. That's how much is going to be paid to us at the end of the note. Now, if the note is dishonored, we have the same kind of problem that what happens if they don't pay the note? Then we're still had earned the 25, and we're going to have to revert it to some other components. But the due date of the note, we still need to do something, meaning we need to take the note off the books. It's past due. And then we're going to record the interest. We still earned the interest for renting the money. And we're going to have to debit something. We can't debit cash. So we could put it back into accounts receivable, tracking it back into accounts receivable so that we can track in our subsidiary ledger this customer, this individual that owes us money, and track that they still owe us that money somewhere. So we're going to still record the fact that we earned interest revenue. We still need to take the note off the books because the term of the note had ended, and then we can put it back into accounts receivable as a holding account to let us know that we still have this dishonored note and we still want to try to collect on it and go through the collection process for it. There's also a case that we might have an adjusting entry at the end of the note time period. And that'll happen because remember that we make financial statements as of the end of the month or the end of the year. And the note term in this case is 90 days. So what that means is that, for example, here we have the note term, it happened on January 15th, and we're going to make financial statements as of January 31st. Then we're going to have some days that fell in this month where we earned revenue, we rented money out, kind of like if we rented a house out, we earned revenue, but we're not going to collect the rent until next month after the end of the close here. That means that there's rental money that was earned, which we should recognize as earned it. We earned it because we loaned out what we loaned out, not a house in this case, but money. And so we should recognize it in this time period, even though we have not received the cash. That's going to be an adjusting entry. So to do that, we're going to have to figure out, well, how much did we earn as of the end of the month? So it's a 90-day note, but how much did we earn in January? And we have to figure out, well, that depends on how many days it was outstanding and the interest rate. So we'll do a similar type of interest calculation. We got the principal, we've got the interest rate is 10%. 10% times 1,000 is $100. Then we've got the days in a year. This would be $100 per year, remember. 360 days, which we're saying 12 months times 30 days to make it even. 360, $100 per year times 360 days is 0.28, 28 cents per day. Again, that's rounded. It's really 0.277. This is the same calculation we had prior. Now we're just going to make a slight difference. We're not going to multiply times the term of the note, the 90 days, but by only the amount of days that are remaining in the note, which is 16. So if we did this in a calculator, remember what we're saying is there's 31 days in January minus 15. That means there's 16 days left, and you have to be careful in terms of, are we going to count the day of the note or not? So if you're off by a little bit, that might be the difference if we're counting the 15th, the day the note was created, or not. The difference when we calculate it here, 31 minus 15 is not calculated, meaning if we counted it up on our fingers, we would count starting with 16, 17, 18, up to 31 would be 16 days. So if we do this calculation, then we're going to say we had $100 of interest divided by 360. That gives us 0.2777, and that's about 0.28 times 16 days, and that gives us 4.44. Again, it's not perfect, but it's about $4.44. Now this amount seems minor, and it is, so in this adjusting entry, but if we had a lot of these adjusting entries, or if the dollar amount was larger, this could be a material adjusting entry that we would want to make sure that we record in order to represent the financial statements correctly as of the date we make them, the end of the month, the end of the year. So to record the adjusting entry, we'd have to say that we have interest receivable of this $4.44. In other words, at this point in time, we have the notes receivable already on the books when we first recorded this at $1,000. And we're not going to record this amount in the receivable itself. We're not going to say the receivable is $4,004.44. What we're going to do is make another account called interest receivable, and that's where we're going to accumulate the interest, which is related to this note. It's an asset. Asset have debit balances. It's a receivable. It's going to go up by doing the same thing to it, another debit. Then we're going to record the interest revenue that we earned. We didn't get paid yet. We haven't gotten cash yet. But we did record interest, and remember that's just the rent on the money that we loaned out. Interest is a revenue account, or interest revenue is a revenue account, has a credit balance, as all revenue accounts do. We're going to make it go up by doing the same thing to it, another credit, increasing both the revenue account and therefore net income. In this presentation, we will take a look at how to calculate simple interest a few different ways. As we look at this, you may ask yourself, why are we going over this a few different ways? Why not just go over it one way, the best way, and let us learn that well and be able to apply it in each situation? While one way does work in most situations, in other words, we will probably learn one way, have a favorite way to calculate the simple interest and apply that in every circumstance. It's also the case that when we look at other people's calculations or textbook calculation, they may have some different form of the calculation. For example, I prefer a way when I think about the calculation of simple interest to have some subtotals in the calculation and have more of a vertical type of calculation the way we would see if done in something like a calculator. If we see a type of equation in a book, then the idea there is to have the most simple type of equation expressed in as short a way as possible, and that typically is going to be some type of formula, and that formula will often not be showing the subtotal. So in other words, a textbook has an incentive to show a very compressed type of format for calculating something, and individuals, if we want to go back to it, note what happened in it, then we often will benefit by having some subtotals in the calculations that we work through. That's one type of difference we want to know. Other reason we want to know different methods is just to understand the math a bit better. If we understand different approaches, we understand what we are actually doing a little bit better. Another reason is that different people are going to have different minds in terms of how they think of things and how they process things. So we want to be able to look at someone else's work and say, okay, I see what they did here, and be able to apply that to ourselves and see what they're doing. And again, the more we can understand how other people process things, the better we understand what the material is and how to communicate it to other people. So let's go through a few of these type of ways we can calculate simple interest. So we're going to start with a loan of $50,000, 7% interest rate, and it's a 90-day loan. It's going to be out for 90 days. So we'll start out with the loan amount, $50,000 for our first calculation type. We're going to multiply that times 7%. Now note if we have a calculator, we're typically going to do that by saying 50,000 times 0.07. 0.07, if we're in Excel, we format the Excel to be percents. We can have a percent. We can use this percent button up here, but I typically use decimal 0.07. If we move the decimal 2 places to the right, then of course we would have a 7%, and that would give us the 3,500. So in other words, 50,000 times 7% is 3,500. First thing we need to note, this 7% means 7% a year. Unless expressed otherwise, whenever we say that something is so much percent, typically we mean percent a year. So for example, if we say we have a mortgage, we pay the mortgage monthly, but we typically express the mortgage rate as a yearly rate. Why would we do that? There's a couple different reasons we might do that, but one main reason that it's a convention for us to do that is if we took 0.07 and said we want a monthly type of interest rate, if we divide that by 12, we get a pretty small number. So it would be 0.58 something percent, which is pretty small. We don't really, that's a range that's more difficult for us to express in. Therefore, we typically express interest rates for that reason, and just it's a convention, in years. So unless expressed otherwise, just note within a problem, within any type of discussion, interest typically means a year. And it's similar to if we're talking about a salary, like we say someone makes $70,000, we typically probably mean $70,000 a year, even if not stated. Then we're going to take that amount and we're going to say how many days are in a year. Now in this calculation, we're taking 360 to make an even rather than 365, which is an assumption of 12 months times 30 days in a month. Of course, there are 31 days or 30 days or 28 days or 29 days in a month. But if we do a nice even calculation here, we get an even 360 for our simple interest calculation. So that's what we will use at this time. So then we're going to take the 3,500 per year of interest. This is the dollar amount. And this is going to be 360 days, gives us about $10 a day. Again, that's rounded. It's really 3,500 divided by 360 gives us $9 0.72222. So I'm going to use this 10 here just to show it. That's how you'll see it in Excel if you take the decimals off. But note that we're really going to be multiplying by that 9 something. And just remember, when you deal with interest, you're going to have to deal with that. Not everything's going to round out to the dollar. Not everything's going to round out to the penny. And we'll have some rounding differences. So then we're going to take that times 90, that number times 90 days, and that'll give us 875. Again, not 90 times 10 in this case, because we're using the rounded numbers as we would see in something like an Excel worksheet. So you just got to kind of deal with those kind of things. So if it was 10 times 90, it would be 900. What we really have is the 360 divided by 3,500. Let's do that one more time. What we really have is the 3,500 divided by 360, or 9.72, which was rounded to 10. Taking off the pennies, and then we'll take that and we multiply it times 90 days, and that gives us our 875. So then if we take our 875, that's how much we would earn then for the time period for the 90 days at 7% for simple interest. If we take the original amount of the loan, 50,000 we loaned out at day 1, we add to it the 875, then we get 50,875 that we would then receive at the end of the loan term. This is the way that, one of the ways I think is the most easy to see this, and that's if we break it out by days. Depends on the loan type if we want to break it out by days or months. So if it's less than a year, then it might be that we want to use days. If a problem's getting very specific, then we'll have to use the actual number of days in the month. Just got to be careful on the terms of the problem. If it's going to be a longer term problem, then we might just round these to months and use months as the calculation, as we'll see this time. Same type of idea. We'll take the 50,000, multiply times 7%. That's going to give us our 3,500. So 50,000 times 7%, the yearly rate, gives us the 3,500 interest per year. Now we're going to take that and we're going to, instead of dividing it by 360 days, we'll divide it by 12, giving us the interest rate per month, 3,500 divided by 12. So again, if we did that with the calculator, we're taking 3,500 divided by 12. And that gives us not exactly 292, but 291.6666 on forever. Note that even if I put the pennies there, it's not always going to be exact. And we're just going to deal with that. That's going to be some rounding issues we will always have when we do these types of calculations. Then we're going to take that amount and multiply it times 3. Where do we get 3? 3 months. 90 days divided by our convention, 30 days per month, about, gives us 3 months. Then we're going to take this dollar amount per month times the number of months, 3, to give us that 875. Remember, we're not talking about the 292 necessarily. We'll have rounding there. It's off by $1, because really what we're talking about is the 3,500 divided by 12, or 291.6666 on forever, times 3. And that'll give us our 875. So just be careful of the rounding. It's always going to be a problem. Doesn't matter how many places we take it out to. Some of the decimals will repeat forever. So we'll have the 50,000 plus the 875 getting us to that same 50,875. These two ways, the prior way by day and this way by month, are the easiest way for me to think about it because it's linear. This is how you plug it into a calculator. This shows us each step and the subtotals. However, if you were to represent it with as short a way as possible, then these subtotals aren't something that are typically going to be represented in textbooks because it's not as neat, not as nice. So when you put things out and you calculate them, I would remember them in this format. This is easier for me to remember than a shorter type of formula because the shorter formula doesn't make intuitive sense. I can't say, well, walk through this and say, well, this is the yearly interest rate, this is the rate per year, and then we're going to take the rate per month times the number of months to get the interest. So I can't really tell the story to myself. The longer story that I can tell is easier for me to remember than a shorter formula which has no story, if that makes any sense. So anyways, bottom line, I would remember one of these two methods for your default method. Okay, so now we're going to do another method. We're going to start off with the number of days in the loan, 90, and we're going to divide that by the number of days in the year. This, of course, is called a ratio. So we're comparing and starting off with the comparison of the loan term, 90 days, divided by the number of days in the year, 360, which again is 12 times 30 for our purposes, rounding it. Instead of 365, it's 360. And that's going to give us 0.25 or 25%. So here's our ratio giving us 0.25. Now that we have that ratio, we can take that ratio, that 0.25, and multiply it times the interest per year, which was that 3,500 or 50,000 times 0.07, that 3,500, and that'll give us our 875. So note this gets to that 875 a bit faster here. We don't have as many calculations or as many steps. However, I find that most students, and myself included, when I think about this, the ratio doesn't make as intuitive sense to me as saying, oh, here's the interest rate per year, here's what the interest would be per year, and then breaking it out to either a daily or monthly interest rate and then multiplying times the number of months. Same math, same end result, just a different order of calculations. So just be aware that this, because it's smaller, probably often more represented in a textbook or something. We need to be able to see that. So then we got the 875 plus the 50,000 original gives us the loan that we'll get back at the end of this time period. If we loaned out 50,000 at 7% simple interest, 90 days, we should get back 50,875. Next, we'll do the same type of thing, but now we're going to do this by the number of months in the loan. So remember, this is going to be 90 divided by 30. Gives us 3 months in the loan. And then we're going to take that and compare it to 12. 3 divided by 12, 3 over 12, that gives us the ratio of 3 to 12. So 3 divided by 12 will give us that same 25. So note we're doing the same thing, of course, because we're doing the comparison of the time frame the loan is over the total time frame, and as long as we use the same measuring tools, as long as we're in this case using months, or in the prior case we used days for both the loan term and the amount of time within the year, we will get to the same ratio. 0.25 is the percent. So then we're going to, and of course you can simplify these down to and see that the same ratio, 3 over 12, if you simplify that down, then and you simplify the 30 compared to, or the 90 compared to the 360, you'll get to the same ratios, right? So there's the 0.25, and then we're going to take that and multiply it times the 3,500, which once again is, of course, the $50,000 loan we started with times 0.07, 3,500, and that'll give us the 875. So 0.25 times 3,500 gets us back to that 875. So once again, a bit quicker method than the first two we started off with. A little less intuitive in my experience with myself and people I've worked with for most people to understand, I believe. Total cash received then would be this $50,875. Next method. Now we're going to try to break this percentage out as we saw at the beginning and break it out into a monthly rate, and we'll deal with that. So we're going to say we're going to start with the interest rate this time and say that's the yearly rate. That's what by default it typically is. Divided by 12, and that'll give us the monthly rate. So once again, if I did this with a calculator, we'd say 0.07, that's the 7%, divided by the number of months in a year, 12, gives us 0.0058333 on forever. That's a pretty small number, which once again is the reason we don't typically do that. We don't typically represent the interest rate in terms of months because it typically is a small number and it's just not the convention that we just have out of whatever reason we come up with conventions for. So that's what we're going to have if we break it down to a monthly rate. Now it's important to know this because when you put stuff into Excel or other types of financial calculators at times, then it sometimes uses this monthly rate. So we'll need to know the rate per period, and that's in this case the monthly rate. And so it's important for us to know this type of calculation when we use tools such as Excel. So that'll give us 0.58%. Remember that is not exact here. This is a rounding. Times the loan of $50,000 gives us 292. So once again, be careful of the rounding all the time. Because this is 0.598, you might first think it's 58%. It's not. We got to move the decimal 2 places to the left, which was 0.0058. That's what it really represents, times 50,000. But even that's a couple bucks off. Why? Because this is rounded too. So remember what we had. It's 0.07 divided by 12 gives us 0.00583333, and that's what we're using times 50,000. So again, just be careful. I could give an example that is perfectly even here, but it's not. I'd rather give a less than perfect example to show that it's not going to be perfect all the time. It'll be perfect sometimes. So this would be the amount of interest per month, simple interest per month, and now we just need to say, that's a $, by the way. Now they've got to say there's how many months in the year. We're going to say that in the term of the loan, 3, or 90 divided by 30, 3 months. So 292 times 3 would be 875. Once again, that might be a bit of rounding there. If we say 292 times 8 times 3, we're going to get 876. Why? Because really what we had, remember, is 0.07 divided by 12, which is 0.0058, and then we multiply that times the 50,000 to get really 291.6666 divided or times 3. And that's going to be our 875. And then if we take the 875 plus the 50,000 gives us that same 50,875. One more time, one more way, and then we'll stop this. Okay, so we're going to take that same interest, 7%, break it out to a monthly rate. So 7% divided by 12 gives us that 0.58%. Once again, this is rounded, same spot we were at last time. We now have a monthly percent. Now we're going to take that and multiply times the number of months. So we have 90 days divided by 3 divided by 30 gives us 3 months. So if we take that 0.58 rounded, this is rounded, times the 3, we get about 1.75. And this then would be the interest rate per the time period we're talking about, 3 months or 90 days. So in other words, if we take a look at this, we have the interest rate 0.07 for a year divided by 12 gives us the interest rate per month. If I move the decimal point over, it's 0.58333. This is rounded. This isn't 58%, remember. 0.58, big difference. And then we're going to take that times the number of months, 3, and that's going to give us 0.0175 or 1.75%. So this is actually exact now, 1.75%. And then we're going to take that times the loan amount, 50,000, and that'll give us the 875. So remember, what we did here is we broke down the percent for a 3-month time period, or 90 days. And again, that's not usual. We don't usually say that. We don't usually say, hey, we're going to pay you a simple interest rate of whatever for a 3-month time period. So just, be aware that we don't typically say that we're going to pay you 0.58 per month. We typically express things oftentimes with a yearly rate, that yearly rate often being between 1 and like 20, and therefore being an interest rate that makes more sense to use. It's within that range. So, but when we do financial calculations, this once again might be a way that we could see this within the periods that we're talking about, which in this case is a 90-day or 3-month period. So then we just take that interest rate times the 50,000, gives us the 875. If we add that to the original 50, we get to that same 50,875. So again, I hope this wasn't too confusing or more confusing than it was helpful. But note that when you see these types of calculations in a textbook, they're often so simplified they look to be like the easiest way to see it, and they are the easiest way to write it. But obviously, oftentimes, a longer type of calculation, a more vertical calculation rather than a horizontal type of formula, is easier for us to think through, tell a story in our head, remind ourselves what we're actually doing in order to better memorize the calculation for future use and application to other types of problems. as well as to just have a format and be able to understand it better for future use and know what we're actually doing, rather than spitting out a number that we think is correct just based on the formula, but not having any intuitive realization or understanding what it's for, and therefore how we can use it to apply to something. In this presentation, we will discuss notes receivable, giving some examples of journal entries related to notes receivable and a trial balance, so we can see the effect and impact on the accounts, as well as the effect on net income of these transactions. First transaction, we're going to have a 120-day 7% note giving the company MI an extension on past due AR or accounts receivable of $6,200. When considering book problems and real-life problems, one of our challenges is to interpret what is actually happening, what is going on, which party are we in this transaction, and therefore how are we going to record this transaction. When we're looking at notes receivable, a common problem with notes receivable is the conversion of an accounts receivable to a notes receivable. So in this case, that's what we have. We have an accounts receivable here that includes an amount due to us by this particular company, MI. So these are our books. We have a receivable, people owing us money for prior transactions, goods or services provided in the past, and they owe us, in total, all customers owe us $41,521. This customer in particular owes us $6,200 of this amount in the receivable. That could be found not in the general ledger, which would give backup of transactions by date, but in the subsidiary ledger, supporting this amount, giving us this number broken out by customer, in this case showing that this company, MI, our customer, owes us $6,200. If we were adding up all the customer accounts in the subsidiary ledger, which we only see the one here, all of them would add up to the total accounts receivable. Now, the accounts receivable represents sales that are made that are typically due in, say, 30 days. And a note receivable, on the other hand, typically has a longer time period. Interest rate involved often has a higher dollar amount, and therefore interest will be charged and want to have that in writing. So in this case, we're going to say, okay, it was in accounts receivable, but now we're going to give an extension, and because of the extension and the days being greater than, say, 30 days, we don't want to track it in accounts receivable and in the subsidiary ledger, but create another account and track it in a note receivable and then charge interest on it. So we can imagine a formal document being made here for a note receivable, and we then now having to record this. So to record this, note, we don't really need to know the 7% or the 120. All we need to know at this point in time is that it was in accounts receivable and we're transferring it to notes receivable. So accounts receivable has a debit balance. We need to make it go down. So we're going to do the opposite thing to it, which is a credit, decrease in the receivable. And then we'll put it into notes receivable, which is another asset account, very similar to accounts receivable. And it has a debit balance, and it's going to go up by doing the same thing, another debit. Now note here that we're recording the note receivable, a different note receivable for each customer. So in other words, the accounts receivable we're tracking in one account here, supporting that account with a subsidiary ledger, which then will track each customer that owes us the money. With the notes receivable in this example, we have a different note receivable for each note outstanding, and we'll track the amount owed, the principal amount owed here, as well as supporting documentation to be able to track the principal and interest that is owed. It is possible, however, for us to track this with just one account on the trial balance as well, and then have supporting documentation in a similar way as the subsidiary ledger for the notes receivable, which would calculate both the notes receivable due to us and the interest that would be due on those notes receivable. I kind of like to see it if we don't have too many notes receivable in this format, so that we can check each note receivable. When we make the financial statements, then of course, we're not going to list out a bunch of different notes receivable with different customer names. We're just going to put it together in one account called notes receivable. If we record this out then, we can see the accounts receivable started at $41,521. It's going to go down by this 6,200. We're recording this accounts receivable, making it go down to 35,321. 41,521 minus the credit 6,200, giving us the 35,321. Notice here we're representing the debits with non-bracketed numbers, the credits with bracketed numbers, and therefore if we do sum this up, debits minus the credits equals 0, debits minus the credits equaling 0, meaning debits equal the credits and we are in balance. Net income is calculated as the revenue minus the expenses. We're not showing any right here because we're simplifying the chart of accounts. So all we have are revenue accounts, revenue, interest, revenue, and a gain here to get to the revenue, not a loss, revenue or net income, 38,245. The second component, notes receivable, started at 0. It's now going to go up in the debit direction by 6,200 to 6,200. We also need to track this account. This gives us total accounts receivable owed to us by all customers. We're going to track the activity in the subsidiary ledger for MI company, a particular customer who owed us 6,200. We credit this same credit here, similar to as we would do for the general ledger, but now breaking it out by customer, saying that they no longer owe us any money. So this 35,321 is all made up of customers other than the MI company customer. If we look at the full transaction of all of our accounts at the end of the day, here's where we started, here's our adjustments, here's the ending trial balance. All that happened, one asset account goes down, one asset account goes up. No effect on the accounting equation in essence. Assets went up, assets went down, no effect on equity, no effect on liabilities. You can see down here in the income statement accounts, nothing happened. No revenue went up, no expenses. Net income is the same after this transaction. Just transferring from one account to the other account, one asset account to another asset account. Why? Because this asset account will allow us to track not only what is owed to us, but then we'll want to calculate the interest on it and the longer term of days. Then we're going to say, okay, what happens at the end of this time period? We're going to get paid both the principal and the interest, and therefore we need to calculate what that interest will be. So the principal amount is 6,200. The interest rate is 7%. 6,200 times 7% is 434, or 6,200 times 0.07, 7%, 0.07 is 434. Then that would be, remember, for an entire year, and we're going to need to break this down to the time period we're talking about, which is only 120 days. There's a few ways to do this. We'll talk more about different ways to do this in a later presentation. But here what we're going to do is break it out into an amount per day and then multiply times 120 days, which I think is one of the most intuitive ways to do this and makes sense to many people. So we're going to say that 434 divided by 360 days gives $1.21. So what does that mean? Where did we get the number of days at 360? We're going to say 12 months times 30 is 360. There's really 365, but we're going to round it for simplification purposes for simple interest calculations. We're going to take the 434 divided by the 360, meaning 434 interest for an entire year divided by 360 days is about $1.21. We have to deal with rounding. That's okay. For each day. So then we're going to take that 121 multiplied by the number of days in the loan, 120 days, to give us the 145. Now again, remember that if we take the 121 times 120, we get something slightly different here. Then if we took the rounded number, 434 divided by 360, gives us really 120.555 times 120. And that gives us still something else slightly different. We're rounding to the nearest dollar. So just be careful of rounding. It's always going to be an issue. Even if we go to the penny, it's still going to have rounding issues because we're off by, less than a penny. So always going to be an issue, and we'll have to deal with it no matter how we structure the information. So here we go. we're going to say that the interest was $145. What happens when we get paid then at the end of the loan period? So now we're at the point where they're going to pay us. We loaned originally $6,200. We're going to get that back plus interest of $145. So the note receivable is going to have to go off the books. Here's the note receivable. It's easiest to see this when we have a trial balance, because we can see, hey, there's the note receivable. We got paid on it now. That needs to go to zero. It has a debit balance. We need to make it go down. Therefore, we'll do the opposite thing to it, a credit to make it go down. We're also going to have the interest revenue. That's this revenue that we generated. It's not included here. We're going to get cash not of $6,200, but $6,200 plus the $145 because of the time value of money, the interest that we've earned. That's going to be interest revenue. It's an income account. Income is going up. Revenue has a credit balance. We're going to increase it by doing the same thing to it, another credit. So we'll increase revenue, increase the net income. Note that this revenue is not going up because we made a sale, but because we loaned money. We loaned money and time value passed, therefore we generate revenue from it. The debit to cash then will be the $6,200 plus the $145, or the $6,345. If we post this out, then we're going to say that cash went up. So here's cash here. We're going to post that here. It started at $39,429. It's going to go up in the debit direction by $6,345 to $39,429. Accounts receivable started at this $6,200. It's going off the books now, and this is a check figure that we should have. It should go to zero, and that should be intuitively the case. That it should go to zero because they no longer owe us money. If we have the trial balance, this becomes much easier for us to think through, construct the journal entry, and then post it and see if it does what we think it should do. A nice worksheet format is a good way to see this rather than having the GL and post into the GL, because this gives us a quick view of these accounts, allows us to stay in balance after we record it and see what happened here very quickly and easily. Then the interest revenue, we're going to say interest revenue is a revenue account. It was at 146 prior to this. It's going to go up in the credit direction where we're posting this 145 interest revenue by 145 to 291. If we take a look at all the accounts, then we can see that the cash is going to end up here. We got the notes receivable is down, and the effect on net income then is going up by that 145. We're recording this entire 145 at the point in time we received the cash, because we earned revenue not at that point in time, but throughout the time period, throughout the 120 days. So instead of us recording the revenue that we're earning for loaning money out for the interest each day as it accumulates, we're waiting until the end of the term, and then we're recording this at one time at the point in time that we receive the money at the end. So just be aware that under the accrual method, this revenue didn't happen at one point in time. It happened over 120 days. It's just easy for us to record it at the end of the term when we get paid. Now, if the term goes over the adjusting entry date, the end of the month or year, we may have to then do an adjusting entry to recognize the fact that we did earn revenue over time, not at this one point in time at the end of the time period, and we'll see an example of that shortly. What would happen if at the end of the time period they dishonored the note? We didn't get paid. We'd have a similar journal entry, but of course we wouldn't get cash then. We're saying they didn't pay us. So we would say that the notes receivable is still going down. We still have to take it off the books. So it's at $6,200. We didn't get paid. It needs to go down to zero. This is a debit. We'll do the opposite, a credit, to make it go down. We're still going to earn the interest revenue. It's not like we didn't earn the money even though we haven't gotten paid on it. We haven't given up on it yet. We're not going to debit cash yet. We're going to debit instead accounts receivable, representing the fact that they owe us the money, putting it back into account that we can then track them and be able to see if we can have collection action on it within accounts receivable. So the only difference here, of course, being not cash, but accounts receivable. Accounts receivable being up, going up. It started at $35,345. It's going up by $6,345 to $41,688. The note receivable started at $6,200. It's going down by $6,200 to zero. And then the income would still be going up. It had revenue of 146. It's going up by 145 to that's 291. We also need to record down here in the subsidiary ledger. We increased the receivable. We need to record that here in MI Company on the subsidiary ledger, increasing the fact that it's not at the principal now, 6,200, but the principal plus the interest that is owed to us back in receivable. Now this is an area that we can further track how much is owed, further go through the collection process and see if we can collect on the amount owed. Once again, if we see all of the accounts, we can see that there is an effect on net income. Even though we didn't get paid cash, it's going up by the interest revenue recorded here. Remember, this is the income statement part. So we had 20,000 revenue plus this 145 increasing, and this gain down here for revenue. We're not showing any expenses right now because it's a simplified financial statement, so we don't have any expenses at this time. Now, what would happen if we had an adjusting entry? Note that we recorded this 145 as of the end of the time period. What if we had an adjusting entry? For example, what if we made this loan term as of the middle of the month? There's 15 days left in the month, let's say the month of December. There's 15 days left in the month, and we need to record then the fact that we generated revenue over that 15 days, interest revenue, even though we're not going to get the money till next year, next month, after the cutoff date. So we'll have to do an adjusting entry in that case. So we'll have the principal amount. We're going to calculate the interest now for that 15-day time period so we can do the adjusting entry. Principal 6,200. Interest is the 7%. The same 434 we did prior to this calculation. But now we're going to divide it once again by the number of days in a year, 360. 12 months times 30 days. That'll give us about $1.21 interest per day. And now we just need to multiply times the number of days. This is where we differ. Rather than having 120 days, we're just going to multiply times the 15 days that have passed for this current month that we're in. So 15 days, which will give us $18.08. And we're going to round it to $18. So if we did this with a calculator, we'd say, okay, there's 6,200 times 0.07, 7%. That gives us the 434 interest if it was for an entire year. We only have 15 days that we're looking for. So we'll break it out into a daily total, dividing by the number of days in a year, rounding, not 365, but we're going to use 360, 12 times 30, divided by 360, gives us 1.20555, about 1.21. We'll take this number, the unrounded number, times 15, and that'll give us 1808. We're going to round it to $18 for our journal entry. So then we'll do the journal entry here, and we'd have to say, okay, well, as of the end of the cutoff date for our adjusting entry, we've got interest receivable of 18. We're not going to put it into the loan amount. We've got 6,200. You could think, well, why don't we debit the loan? They owe us now not 6,200, but they owe us 6,218. But typically we'll record it separately and say, hey, this is the principal, and then we'll record all the interest that we've generated in the receivable amount here. And then the credit's going to go to interest revenue. So even though we have not yet gotten paid, we have been generating revenue. Note, under a perfect accrual system, you might be saying, well, we should be recording revenue each day, each second, each minute that time passes, because that's when we earn it. But clearly that's not practical. That's why we're only going to record the revenue that happened over this 120 days at the end of the loan date, typically, or we'll record it at the end of the financial statement date at the point in time that we make the financial statements and therefore want them to be as correct as possible for presentation purposes. So, recording this out, we had interest, receivable, and asset accounts going up in the debit direction, started at 0, up by 18, debit to 18, debit. Then we've got the interest revenue starting at 146 here. It's going up by the 18 to 164. Okay, and then if we see all the accounts, then of course revenue is increasing. Even though we haven't received the money, we do need to recognize revenue. And this may look immaterial right now. It's not very material, meaning it's not going to affect decision making too much in this example. But if there were a lot of notes receivables, or if the dollar amount was larger, this could be something that would affect decision making and be material to financial statements. So we're going to recognize the revenue that has been earned during that time period. On the income statement side, increasing net income, even though we have not yet generated the cash, because we have earned revenue over that 15-day time period. And we're going to recognize the receivable that is owed to us as of the cutoff date, that $18. We're not going to get paid until the end of the time period, the 120 days, and we're going to accumulate more receivable as that time passes for the days that pass. But at this point in time, we've accumulated $18 more on the original $6,200 that is due to us.